Co-powered by SBI. Best है सबको पता है. And Century Ply Club Prime. Raho befikar.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Middle of the week, we are coming to you live from the CNBC-TV18 Motilal Oswal studios. Well, I think the Japanese are happy a lot today, this morning. But lots to talk about, as always. Single stocks more in focus than the broader market, I reckon. I'm Prashant. With me, my colleagues Surabhi and Nigel. Guys, good morning.
Hi, guys. Good morning. This morning, reading all of those trade deal developments across Asia, I kept seeing, is there India somewhere? Is there India somewhere? But no, we're still waiting. But a lot of other Asian, countries maybe are slightly relieved, if nothing else. At least there's some finality to it.
Well, that's right. And, from the music world, Ozzy Osbourne, rest in peace, dreamer. And, no chance to dream nowadays. But, legendary singer.
Absolutely. And,
many memories, yeah.
Absolutely. We'll maybe remember him through the course of the day. But for now, let's just sort of take it from the top with regards to markets and how they are tracking. Well, in terms of price action, there is not much. If you just look at what the US market left us with. So quiet kind of day. NASDAQ was down about 0.3%. Nothing very much. The S&P was flattish. NASDAQ was down about 0.39, 0.4. The dollar index continues to weaken, right? So you basically have yesterday, in 2 days, the dollar is down about 1%. This is the broader dollar. And we're now at about 97.46. US-Japan trade deal was announced. And, Japanese goods will face a 15% import levy and see Japan invest about $550 billion in the US. So this is the basic broad deal which has been announced. It is unclear at this stage if Japanese auto and parts would receive a carve-out. Remember, the number which was doing the rounds for auto imports into the US was 25%. So, will Japanese auto exports into the US receive that carve-out? We don't know. By the way, on the Truth social media platform, President Trump said, well, US autos also will get a big footing in Japan. But the point is, the traffic with regards to autos is out, not in. Japanese autos sell hugely in the US, but, the US cars are not very popular in Japan. So, that's just something to note as an aside. By the way, Toyota stock has jumped about 10%, and other Japanese car makers are also higher on the back of expectation, and I think clarity, etc., will come that these are essentially being carved out from the 25% tariff because of the deal, the broader deal, which both countries have struck. On other tariff news, Philippines essentially got a 1 percentage point decrease in their tariff rate as opposed to what they got in the letter. So it was 20%, it's now gone to under 19%. Not very much, right? US-China talks, and this is the Treasury Secretary Scott Bessent who confirmed that the US-China talks will take place next week. July 28th and 29th is when the next set of talks will take place. He also, by the way, talked about Fed Chair Powell. He said, well, there's no reason for Fed Chair Powell to step down. His term ends in May. He can continue till then. If he wants to step down before that, it's his choice. He kind of left it out there, but basically saying that there is no reason for him to go. President Trump, by the way, continued, in a way, his criticism. He said, well, Powell, and I'm paraphrasing, is going to be out soon anyway. That is next year. And, of course, he'd like rates much lower going forward. The market, how's the market responding? You got a bit of excitement here in Japan and Japanese stocks, etc. But otherwise, it's been largely quiet. Yesterday, it was a bit of a drift down that we had across the board. Nifty, the Nifty Bank, the broader markets as well. So levels have not really changed very much, except, the intraday spike, especially in the Bank Nifty, did take out the earlier high. But beyond that, not very much. The Nifty first, support 24,882 does not change. And the resistance comes in same levels, 25,255, which is the recent high. And then the 61.8% retracement, which is 25,369. And for the Nifty Bank, the support does not change, 56,204. But yesterday is high because we had a bit of a, the index did zoom up a little bit. 57,286 is that level. So that's the first kind of very near-term resistance which the Nifty Bank needs to get above. So still, I think we are in a bit of a confusing phase. Not very clear if you're in the early phase of a bit of a bounce. It did look like that yesterday morning, but didn't really follow through. We'll need to give it a day, 2 days more to get this sort of confusion cleared, hopefully. GIFT Nifty is indicating a 70-odd point higher start. And I think based on that, if you're able to build on and get above some of these levels that are put out, the resistance levels, very, very near term, I think you're going to start to bet on the fact that maybe the market goes up before it does anything else. Surabhi.
Absolutely. It's all about trade deals this morning. And actually, Asian markets are feeling pretty good. It's the Nikkei that's surging the most. That market's up over 2%. But even other regional markets, they've picked up. Look at the Hang Seng. It's about 0.5% higher. Look at the mainland Chinese market. The Shanghai Composite is also up 0.25%. Australia is higher. So all Asian markets are rising. Whether we will be in step with this feeling or not, we'll find out. It's all about, of course, those trade deals and tariffs. This deal finally getting done. Remember when the earlier announcements had come, those blanket tariffs, and Japan had been handed out 25%. So from that comparison, 15% is looking much, much better. And those stocks, by the way, I just checked Toyota, Nissan, Mazda, Honda. Those stocks are up anywhere between 7%. Some of them are up as much as 16%. So Japanese automakers are really surging. In the last 2 months, Japanese exports to US had come down significantly, more than a 20-25% sort of a decline. So the hope is some of that will start getting reversed as there's finality on this deal. Of course, Mr. Trump is also saying it's going to be a great deal when it comes to jobs. Actually, let's hear him out on this mega trade deal that has been signed with Japan, and then we'll talk about the others.
I just signed the largest trade deal in history. I think maybe the largest deal in history with Japan. And that was done with Japan. They had their top people here, and we worked on it long and hard, and it's a great deal for everybody. I always say it has to be great for everybody. It's a great deal. A lot different from the deals in the past, I can tell you that. But we're doing really well as a country. We're strong.
Okay, so agricultural products, American cars and trucks, that's what he's planning to push into Japan. We'll see where that goes. By the way, beyond Japan, we're talking about the Philippines deal as well, where the tariff level itself hasn't changed too much. It was 20% earlier, and now it's 19%. But Mr. Trump is talking about a bigger military engagement with Philippines as well as part of that deal. So that's gotten done. And the framework with Indonesia has also been declared with clarity. So 19% tariff on Indonesia as well. By the way, no incoming tariffs or no tariffs on US imports coming into either Japan or Philippines or Indonesia. So it's a one-way street. Tariffs only when goods are moving to the US. By the way, Mr. Besant has made it clear that the US could be rolling forward the deadline, that 90-day pause window with China. That window otherwise would expire around the 12th of August, but he's already given an indication that that could be extended as talks with China continue. And he himself is going to be meeting with his Chinese counterparts in Stockholm next week. So watch out for more headlines on the China-US trade deal as well. And with Europe, well, Mr. Trump has said a deal is coming tomorrow. So let's see. Lots of deal talk. India is nowhere in the picture. That's the short point. We continue to focus on our individual local news flow and earnings. Within that, the market has been extremely range-bound. The Nifty finally at least holding on to 25,000. That's been the good story. Let's talk about the flows. And there's a lot of FPI selling that we're consistently getting in India. It's been offset by, of course, a lot of domestic buying. But look at that. This data would also be skewed because of the large blocks that happened even yesterday in some of the stocks like 361 WAM. But for what it's worth, domestic buying of over 5,000 crores, FPI selling of over 3,500 crores. That's something to keep in mind. In terms of individual stock action today, like I said, more about news, earnings, just some names. Dixon, the market's been watching for those numbers, very steady, absolutely in line. KEI Industries, another strong performance from a wire and cables play, very similar to what we saw in some of the other names like Polycab as well. So it's looking good. Margins, you can quibble. Margins have come down a little bit, but that's KEI. Paytm has finally turned in positive on the EBITDA front and on the PAT front. So we'll get more details around this as we go on. And as always, there's block deal action. I mean, we're learning from sources. Vivek has been picking this up, that there could be large blocks in a couple of real estate names like Oberoi and Macrotech today. So we'll watch for this. So Nigel, my guess is that while the world works around the trade deals, we'll still keep looking at individual stocks here?
Well, Trump kept talking about making America great again. Just looking at the Japanese market, it appears Japan as well is becoming great again because the kind of rally that we're seeing out there, stocks flying between 5 to 10%, and the index itself is up and about. Coming back to our markets, the data points that we got yesterday, there were mild shorts that were added into the system. In both on the index futures as well as stock futures, some of this will be an arbitrage, but there were some shorts that got into the system, which isn't such a bad thing. And post the short edition, the FI net short positions, well, last is at around 86%. It continues to hold, at around that 86%, and now the short positioning, net short positioning, has gone to around 1.5 lakh contracts. I think we play out the expiry and then we brace ourselves for a bit of a bounce. At around 1.5 lakh contracts, normally you should see a bit of a bounce, and the PCR as well has come down. It's holding at around 0.84 odd. At around 0.7 is where we see a bounce. The reason that we are seeing that the PCR has come down because, call writing has been very, very aggressive. From both the big participants, the clients as well as the FIs, the number of calls written are way more than the number of puts. So telling you that the call writers, they feel that higher levels are going to be protected. So what are the levels? Going by the action that we are seeing, at around the 22,200 call, where more than 50 lakh shares are getting added. The premium has come down to around 29 rupees or thereabouts. Aggressive writing being seen out there. While at that 25,050 put, there is mix of activity, and there was only 12 lakh shares getting added out there. Going by the options data, since the 25,200 calls saw writing, the near-term resistance comes in at around 25,250. So that range of around 25,250 to around 25,325, which is a 20 DMA, that becomes a crucial resistance mark. On the downside, the recent low becomes your reference point. For the time being, it appears we're in this range of around 400 points. Given that today we'll have Infosys' numbers, I'm going to keep an eye out on some pre-positioning on the IT pack. Because remember, that index actually has been a rank underperformer. Infosys is one of the few large cap names that could deliver some kind of growth. And there is an expectation that they go ahead and they increase their guidance as well. That's what the street broadly estimates. But I'll watch out for some pre-positioning on this particular index, the IT index, whether or not we see a bit of a pop towards the end. Keep an eye out on that. In terms of stocks that I'm looking at, well, you have Godfrey Phillips. That's going to be a stock that I'm looking at because you saw big delivery-based buying. The stock has crossed that 20 DMA and it's very close to its 52-week high as well. And yesterday, there was a good amount of delivery-based buying. Philip Morris, in fact, they came out with their set of numbers, and on the whole, it looked disappointing. But the commentary on the India business actually was quite positive. So I'll keep an eye out on Godfrey Phillips for today's trading session. Let's see whether or not the street reads a little bit into that. And the other one that I'm looking at is purely sentimental in nature since the Japanese stocks are doing very, very well. Decade India has not done much in the last few years or so, but it's got that Japanese parentage as well in there. So maybe some kind of positive sentiment rub-off. We'll keep an eye out on this name.
Nigel, thanks very much for that. So Japanese auto wangs are doing well. Drew Pettit is Director, U.S. Equity Strategy and ETF Analysis and Strategy Research at Citi. He's with us now on the program. Drew, good morning. Great to have you back on the show. Thank you very much for your time. Deals are coming, not just here with India. And I think we reported yesterday that a deal is unlikely before the 1st of August, and another U.S. team perhaps comes here, post that deadline, and talks will continue. Drew, I mean, what's your sense? I reckon generally overall market assessment of where tariffs will finally settle are rising and have risen quite fast over the last few weeks now. They were consensus was, I think, around between 10 to 15%, closer to 15%. That number is now closer to 20%. Would you agree, Drew?
I would say it's shifting, but we're not all the way back to where the numbers were on Liberation Day. So I think the deal and the news we're seeing right now, Japan on Liberation Day was looking at about 24% tariffs, 15% is a win, in a sense. What has shifted? While we do think tariffs are probably drifting a touch higher versus our expectations, leading into all of this, we actually have some tailwinds now with the Trump administration signing the One Big Beautiful Bill law. So there are incentives for businesses that are investing in the United States. It'll show up as tax tailwinds that offset some of the tariff headwinds. Even if they come in worse than people have kind of modeled, if they're better than Liberation Day, you see that counteracting with the tax bill passage. It's mildly more positive than really how a lot of us were thinking, but let's call it 3 months ago.
Hi, Drew. Well, in the midst of all of this, the market's just surging along, right? And you can't blame it because earnings have been good so far. The big banks have been good. We'll see how the tech guys do now. But what's your sense? Further upsides for U.S. equities?
So it's funny, I have to answer this question in two parts, to be honest with you. Tactically, more short term, the market looks pretty fully valued. Sentiment's pretty stretched. Investors are paying a pretty high multiple for those earners, for those good earnings stories. So a little bit of tactical pullback here in the United States should be expected. Return were positive, so we really think you should be buying into that, especially for the growth names in the U.S. To put it really simply, we'd be buyers of U.S. growth on pullbacks throughout this earnings season.
Okay, so you'll be buyers on any pullback. Just on back to Japan, because now this seems to have settled and finally at least there's a rate and it's 15%. And maybe it's not as bad as what the other countries get. Do you expect this to lead to major flows out back into Japan? Remember, it was a couple of quarters ago. I mean, the money moving into Japan was a big, big trade. Do you see that coming back?
You've actually started to see it ahead of this. When I was looking at last month's ETF flows, maybe not Japan-specific ETFs, but you're finally seeing at least American investors buy non-US stocks. You know, going back a month, the flows into non-US listed ETFs, so thinking international equity from an American investor perspective, were about the fourth highest they've ever been on a monthly basis. We're seeing that at the same time we're finally seeing deceleration in US flows. So the flows were happening ahead of this. Could better than feared news continue that flow pattern? To be seen this month, but the tide was changing heading into this announcement.
Hi, Drew. Good morning. Good to see you, Ben. What about emerging markets? I believe China and Korea, they are your top bets out there. India is not making it. Cut to neutral.
Well,
Drew, bring us back to reality.
So we'll stick with China and South Korea to kind of kick this off. You're finally seeing good earnings growth revisions here. So that's been a real big driver to the house call around emerging market allocations. So South Korea, China upgraded. Again, both of those really do play to AI and kind of secular tech themes beyond just kind of the country-specific economic drivers. On India, downgraded to neutral. This is a really interesting story because you finally have some settling out of earnings downgrades. You have a good domestic economic story, but you're already paying a lot for that. So again, holding India exposure at neutral, not cutting it to underweight. It's just recognizing that it has been a good story and markets are pricing that in.
Got it. So more, and in terms of downsides at an index level, Drew, here in India, I mean, did you put something out as part of that call?
No, it's honestly maybe take some profits here, keep that allocation closer to more what a benchmark weight might be, and then buying, again, some of the secular growth stories that maybe markets have kind of forgotten about. Honestly, the trade really, if you're going to boil this down, whether it's EM or just international more broadly, is we can go get AI names in some of these regions at valuations that are much cheaper than what you see in the United States. So the AI trade is broadening, and big benefits of that are going to be in China, South Korea, and Taiwan, which Taiwan at its price is actually a neutral in our EM country weights.
By the way, tonight, Drew, is going to be a big day, right, for AI? I mean, isn't that President Trump going to talk about winning the AI race for America? I think the summit is called that, with David Sachs. I think that's happening later today in the US morning. So I don't know what will be announced, etc. But should be interesting to hear from him. Thank you very much for joining us, Drew. Great to speak with you. Thank you for your time as always. We'll take a quick commercial break here. We're going to come back with our top 10 list. But let me just quickly run you through what's coming up here over the next 2 hours or so. So lots of companies, right? 8:35, you'll hear from the management of IndiCube Spaces. Lots of co-working companies getting listed. So this is a 700 crore issue. 9 o'clock, you'll have Anurag Bhatnagar of the Leela Spaces Hotels and Resorts for their first quarter numbers. 9:20, Dheeraj Agarwal of Ambit will be with us. 9:30, we'll have the management of KEI Industries to talk us through their performance. Saurabh Gupta of Dixon joins us We spoke with him recently, but this is on the back of the numbers. A little later at 9:50, Manoj Kumar Dubey of Indian Rail, IRFC, will be with us for their earnings. And towards the end of the program, Lata in conversation with Santanu Chakrabarti, BNP Paribas, on banking numbers.
Slip into that short break. A lot of stock-specific action to track for you in our top 10 segment. I give you a sneak peek into the list. Dixon, United Breweries, JSW Infra, Paytm, Dalmia Bharat. They'll all be dragged into positive news flow. But add to the list, KEI, Credit Access Grameen and IRFC. We have two large trades that we're looking forward to. The real estate companies, Oberoi and Lodha, will be in focus as well. Take that break, come back, get into further detail on all of them.
For us, the implied open is, coming up on the screen. So maybe we'll have a positive start. But how much can that pop be? Let's see. 70 points. That's what we have right now. Will help the Nifty get back above the 25,100 mark at least. A lot of individual stocks to track as well. Lots of news flow, earnings. So let's straight away get to it. Our team is standing by with the CNBC-TV18 list of top stocks to watch. Guys, morning to all of you. Let's kick it off. Upasana, with you then. Dixon, inline set of numbers?
Certainly, Surbi. Good morning. The company has reported in-line set of numbers. Company's revenue, PAT, EBITDA margin, all in line with our poll. Now, mobile segment continues to drive growth for the company, even in this quarter as well. Coming to the numbers first, revenue stood at 12,835 with an uptick of 95% on a YoY basis. EBITDA stood at 482 crore with an uptick of 94%, which transpired into a EBITDA margin of 3.8%, which was largely flat on a YoY basis, and PAT stood at 225 crore with an uptick of 68%. Coming to the gross margins, there is a downtick of nearly about 110 basis points here. This is mainly because of the change in the product mix of the company. Now, revenue surged nearly 95%. This is largely driven by the strong growth seen in the mobile segment as highlighted earlier. And there are a few changes in the product mix of the company. Company's revenue contribution in mobile and EMS segment has increased significantly from 79% to 91% on a YoY basis, while the company's revenue contribution in other three segments, namely consumer electronics, home appliances and lighting, has decreased on a YoY basis. So all in all, looks like a good start of the year for Dixon Technologies.
All right, thanks for that, Upasana. In fact, we'll be joined by Saurav Gupta of Dixon Technologies. He'll be chatting with us at 9:40 a.m. to detail the past quarter's numbers. A little early in the morning, but time to get to United Breweries. Mangalam joins us to tell us about those numbers. Mangalam?
Good beers, Nigel. Premium beers doing
Not
extremely
contributed,
well.
but they have done. The numbers look good.
I reckon you've contributed, and I'll tell you why as well. Premium beers doing very well. The overall volume growth has come in at around 11%, but it's led by premium volumes, which have actually rallied 46%. Most on the street were working with a number between 20, 25, some above 25, but 46 on a base of 47% volume growth definitely goes down well. What doesn't go down well is, despite this rise, there has been lower than expected rise in EBITDA and the net profit. So if you look at the revenues coming in at nearly 2,800 crores, much above street expectations of 2,750 crores, EBITDA at 310 crores, slightly lower than street expectations of 320 crores, and as a result of which the net profit too has fell shy of street expectations by about 15 crores odd. 11% total volume growth, so that's a positive because it's a double-digit volume growth for the first time in the last 5 quarters or so. And the street was working with a number of just 6 to 8%. Why is that? Because premium volumes, they grew by 46% versus expectations of 20 to 25% growth. The company said they saw continued traction for Kingfisher Ultra, Amstel Grand, as well as Heineken Silver. And volume growth has been driven mainly by Uttar Pradesh, Andhra and Assam. And the reason why I pointed at you, Nigel, because you traveled to Uttar Pradesh and I know that.
I was wondering, yeah, I heard the brands. I don't think Nigel's contributed there, but yeah, the UP angle is a solid one. I agree. Okay, all right, Mangalam. Thanks so much. But let's quickly go on to Vivek as well. He's watching out for earnings from JSW Infra. Vivek, good morning. How are they?
Good morning. A slightly soft start to FY26 as far as JSW Infra is concerned. But the good part is in the conference call yesterday, the management went ahead and retained that 10% volume guidance for the full year. Now, looking at the numbers themselves, the revenue is higher by 21.2%. The EBITDA was up 13%. Higher operating expenses up almost 36%. Dented the core EBITDA. EBITDA margins also on the back of that contracted on a year-on-year basis at 47.5%. Profitability, however, perked up almost 31% on a year-on-year basis. Now, the total cargo volumes that were handled were up 5% And along with that, two confirmations from the management, in post the results. Number one was that the company has received the LOA for the redevelopment as well as mechanization of 2 container berths at Kolkata, and along with that has signed a binding MOU with Konkan Railway Corporation for the development of railway siding in Ratnagiri district. So overall, a good set of numbers coming in from JSW Infra. Soft start, but despite that, execution has been quite good, and guidance maintenance is something that the street will like.
All right, Vivek, thank you very much for that. Paytm is the next one. Numbers look good. Gaurav has got more. Gaurav, morning.
Well, as Paytm definitely looks good for the trade today, and the reason being that company has turned profitable for the first time if we exclude the exceptional items. Now, let's not forget, in Q2 FY25, actually company had reported profits, but that was because of the exceptional items. But in this quarter, they have reported profit, and this is on the operational basis, and this is specifically because of the reduction in cost. So first, let's understand the numbers. Revenue that has remained flat on a sequential basis, but direct expenses, now they have gone down almost by 9% on a sequential basis. As a result, when we look at the contribution profit and contribution margin, that has increased. Contribution profit has increased almost by 7.5%, and contribution margin has increased to around 60%, which is higher more than 400 basis points. Other than that, when we talk about indirect expenses, there also we saw a bit of a fall. 19% fall is what we saw in the indirect expense. As a result, we saw EBITDA was also up. Let's also not forget that in this quarter, ESOPs were low. They were only at around 30 crores versus what it was earlier. It was down almost by 82% on the sequential basis, and as a result, we saw EBITDA actually also turned positive even after ESOPs. The EBITDA margin stands at around 4%, and as a result, when we talk about profitability, that has also come up. Now, company has reported profit of 123 crores. So, definitely a positive number for Paytm in this quarter.
Okay, all right. Positive number coming out of there. These new age companies seem to be turning things around in this quarter. Thanks a lot for that, Gaurav. I'm looking at Dalmia Bharat. The stock is at a fresh 52-week high, and it's seen a big surge in the last few days. The numbers, they look good. So if you look at the revenue number, well, that's more or less in line. A little bit of a miss out there because the volume number is disappointing. It was expected to be soft, and it is a little bit softer than expected. However, the EBITDA number is a little bit better than expected, telling you that the realization factor out there has weighed in their favor. And take a look at the EBITDA per ton. Last couple of quarters, even if you look at it on a year-on-year or even on a sequential basis, it's sub that 1,000 rupee mark. Now it's clocked 1,260 rupees, telling you that the realization has improved. The focus on cost as well are playing out, and that's why you're seeing such a big surge in the EBITDA per ton. The volumes, they were a tad bit disappointing, though. They contracted by around 5%, even X of the JPA volumes, because now it's not a part of the company, which was around 0.4 million tons. It's more or less flattish, which indicates they're not growing as much as what the industry is growing at. The blended realization, though, that was a positive, was up close to 9% on a sequential basis, and they've set out their path from around 50 million tons. They're going to be a 75 million ton plant. And to do this, they've laid out a capex, which has come at roughly around $65 on a per ton basis. It's going to be at Andhra Pradesh and Tamil Nadu, 6 million ton of cement and 3.5 million ton of clinker. Put everything together. Well, going with the green on this one, though you need to keep in mind the stock has already seen a big run in the last few days. Let's go to Upasana, though. She's here to tell us about KEI Industries. Upasana?
Well, it's a good quarter for cables and wire companies, and KEI Industries is no exception. Well, the company has reported a good set of numbers. Revenue and PAT is above pole, while EBITDA margin is largely in line. Now, when we look at the Q1 revenue growth, it stands around 26%, which is higher as compared to the company's full year guidance of 17 to 18% for FY26. So let's see what bodes for the company in terms of the full year basis. Now, coming to the numbers first, revenue stood at 2,590 with an uptick of 25%. EBITDA stood at 258 crores with an uptick of 18%. EBITDA margins were down nearly about 60 basis points at 105. At 10.5, beg your pardon. PAT stood at 195 crore with an uptick of 30%, and gross margins fell by 240 basis points on a one-year basis to 23.8%. This is likely due to lag in passing of the commodity prices. Now, when we look at the cable and wire revenue growth specifically, it stood at 32%, which is much higher as compared to Havells, which reported a growth of 27%, and Polycab, which reported 31% on a one-year basis. So KEI looks like ahead of its peers as of now.
All right. The management will be speaking with us at 9:30. So Mr. Anil Gupta, as always, after the numbers on the channel to talk about earnings. Well, let's go back to financials. Credit Access reported numbers and IRFC as well. IRFC is another management you'll hear from in the next hour and a half. But Gaurav, numbers first.
Well, as Credit Access Grameen came up with the numbers. Now, when we look at the numbers on a standalone basis, they look a little weak because profit has declined almost by 85%. But let's not forget, this was actually expected from the company. What remains positive for this quarter is that net interest margins. Now, they have increased almost by 10 basis points because there is some benefit from cost of funds. And second is that the credit cost, now that has come down almost by 40 basis points. Now, it stands at around 9.2% on an annualized basis. So that was something which is positive. Going ahead, management is also saying that credit cost guidance is given at around 5.5 to 6% for the year. They also believe that the PAR portfolio, which is the early delinquency portfolio from Karnataka, is likely to come down. So definitely positive commentary there. Second company, which is IRFC, there also we saw a good set of numbers. Profit increased almost by 10% on a year-on-year basis. Now, what remains a key thing here as well is that the net interest margins, now they have improved to around 1.53%. This is an improvement of around 11 basis points on a sequential basis. And let's not forget that the company has maintained its NPA profile at just 0%. Now, let's also not forget that this is a company where employee cost is just 0.1%. So definitely, very efficiently, company is actually turning profits. And as a result, this stock is also in our radar today.
Okay, all right, got it. Gaurav, thanks very much for that. And we will indeed be touching base with the IRFC management and get a sense of how the rest of the year could play out. Mr. Manoj Kumar Dubey will join in at 9:50 a.m. Okay, with that, let's move on. We've been telling you about the prospects of perhaps more large trades happening in today's market action. And Vivek has some exclusive inputs on this one. Vivek, so the real estate developers on your radar?
Right, last evening, two real estate companies, they've taken on Goldman Sachs as the broker to this particular deal. So an undisclosed institutional buyer, both in Oberoi Realty as well as Lodha Developers. Oberoi Realty expect a block deal of almost 230 million, translating close to 2,000 crore of equity. Floor price is at a 4% discount to yesterday's close, and total 3% equity is what is expected to change hands. Now, post this particular block deal, it's a clean-out trade, so the seller will not have any stake left. Along with that, Lodha Developers, again, close to 1,420 crore, $165 million worth of shares expected to change hands. Floor price, again, is at a 4% discount to yesterday's close, close to 1% of total equity, and here too, it is a clean-out trade as far as the undisclosed institutional seller is concerned.
Okay, all right. Thanks a lot for that, Viv. Here's a quick recap of all the top stocks that we're tracking, the ones with positive news flow: Dixon, United Breweries, JSW Infra, Paytm, Dalmia Bharat, KEI, Credit Access Grameen, and IRFC. The ones with negative news flow include Oberoi Realty and Lodha Developers. That's about all the equity market action. Manisha standing by to update us about what went on in the commodity space. Manisha, a lot of this commodities higher this morning.
Oh, well, absolutely, Nigel. Especially the metal as a sector has continued to rise for a third straight day today on Wednesday. If you look at steel, we are up by 2.5%. Copper gained 2.5% as well to near all-time highs. Gold was up 1%. It's holding above $3,400 an ounce, not too far away from its all-time highs. And silver, with 0.5% of a gain, has hit a new 14-year highs in the international markets. And the Indian markets overnight hit an all-time highs as well. So a lot of support coming in for this one. The markets are, of course, looking at the US-China meeting next week. And this week is going to be about the European Union and US trade deal. The weakness in US dollar treasuries has continued to support many of these commodities as well. And if you look at the crude oil prices, while we did see a decline of almost 2% yesterday, we've seen some gains come back into the markets yet again. That is because the economic data from China, from the European Union, has been on the positive side. So most of the commodities in Asia are trading in the positive right now.
All right. Manisha, thank you very much for that. So commodities there in focus. I think let's take a break here, right? We'll come back. And as promised, the IPO company, IndiCube Spaces, with their 700 crore IPO, we'll be speaking with Rishi Das on the other side. Stay tuned. We'll also have Deven Choksi join us after that. With
now, IndiCube Spaces, their 700 crore rupee IPO opens for subscription. Through the IPO, the proceeds will be used to fund the capital expenditure of around 460 crores and also reduce debt by around 90 crores. To talk about its IPO offerings, we're joined by Rishi Das, the chairman, ED and CEO at IndiCube. Hi, Rishi. Good morning and welcome to the stock markets. Your IPO opens. So let's get the basic detail out of the way first. You're going to be raising close to around the fresh issues around 650 crores. Break up the expenditure for us. And part of it is going to be used to repay debt. So post the repayment, what will the debt number look like, or will you be debt free?
Yeah. So we are raising, as you rightly said, a fresh issue of 650 crores, and only 50 crores is the offer for sale. And we have only one institutional investor as of now, Westbridge Capital. They are not doing any OFS. They have been invested with us since 2018. And out of this fresh proceeds, 460 crores will go toward capital expenditure and expansion over the next 2 to 3 years. And we are planned a 93 crores of repayment of debt. And our debt currently is 332 crores. And it is from a large nationalized bank and a private bank. It's a low cost debt. Even then, we are retiring a part of that debt. And we are Crystal A plus rated. And the remaining 93, 94 crores will be towards the general corporate purposes.
Okay, Mr. Das, I'm just taking a step back so that people have more clarity on your business model and the operating model itself. You currently have 115 centers. You have 6.3 million square feet of area under management. I'm guessing you don't own these spaces, right? I mean, just explain the model. And you're currently, the top line has been growing very, very well. We'll just put up the numbers. I mean, last 3 years, top line growth has really exploded from 500 crores, you're 1,000 crores plus. But the bottom line is still loss-making. Losses are reducing. Yeah. So just explain the model, and by when can we expect profits at the net level?
So if you, as you rightly highlighted, that we have a total area of 8.4 million square feet under management, with we having a leadership position in Bangalore, which is the largest managed office market in the whole of Asia Pacific and in general as well. And talking more specifically, as you rightly highlighted, the top line has grown in the last 3 years at a CAGR of about 35%. And we have a very, very healthy EBITDA margin. And one thing I would like to highlight that the accounting standard that we use currently is Ind AS accounting standard. And that accounting standard does not factor in the rental as an expense. That's the reason you see that the EBITDA margins are very, very high. Now, the obvious question is, if EBITDA margins are so high, then suddenly how you have a profit before tax loss? That is on account of the Ind AS accounting standard. For example, our total rental payout in FY25 was 502 crores, whereas as per the Ind AS accounting standard, we have factored a depreciation and interest of 690 crores. So there is a 188 crore worth of additional expense that is there. And the company in FY23, when our accounting standard was IGAAP, we have reported a profit before tax of 20 crores. And in FY24 and 25 also, company has been paying income tax. So that is one thing which investors need to watch out for, that due to the accounting standard, they are getting a different perception.
No, fair enough, sir. So get your point. The accounting is, making the bottom line a little lopsided, and we have to understand that. So let me look at the operating line itself. Your EBITDA is growing, but the margin keeps fluctuating. It was 40% in FY23. It fell to about 27, 28%. Last year, it rose to 58%. So at an operating margin level, what is a sustainable margin for your business?
So again, if you look at the EBITDA numbers that you are seeing, there is a fair amount of CCPS, which is the convertible preferential shares that have been issued. And there is again an accounting entry because of Ind AS standards. So that is, so if you look at the cash EBIT, for example, that is a better impression of the business. And that has been fairly steady above 10% all the 3 years, if you look at 23, 24, 25. And it has been, the overall numbers are growing on that account, yeah.
Rishi, hi, morning. What will margins be what are sustainable margins in this business? Surely they're not 58%, right?
Yes.
What are sustainable margins?
So if I were to give you the cash EBIT equivalent, the margins have ranged between, I will say, 10 to 12, 13%. And that is a past indicator. And we have been a prudent player. If you look at our occupancy has been consistently.
Yeah. What is the sustainable top line growth that you see, Rishi?
So again, we can't comment on the future, but if you look at our area, today we have a total area, signed up area of AUM of 8.4 million square feet. We are paying rents today on 6.3 million square feet. So we have a pipeline of 2.1 million square feet, which will get added over the next 6 to 18 months. So that should basically all get occupied over a period of time. So we have a good headroom for growth. We have a lot of space that we have signed up as a pipeline.
Just like you gave that EBIT margin, cash EBIT margin number, if you can look at history and tell us what has growth been, and is that sustainable?
Yeah, so basically, that has been very healthy. As you can see, like we have been between 10 and like you see 13% year before, you will see 12% kind of a number. So it ranges. And why this is slightly having fluctuation is on account of properties that we keep adding, because this is at an overall level. So as you can imagine, if multiple centers suddenly get added, there is a bit of a blip. But again, a good indicator for us is occupancy. And if you look at our overall occupancy has been 82, 83, now currently it is 86%. So if we run our business at good occupancy, I think all these numbers will follow. That has been the trend in the last 3 years.
Rishi, very quickly, 332 crores is your net debt. It comes down by around 93 crores. Is that correct?
Yes, yeah.
So you'll be left with around ballpark 240 crores in your books, which you're comfortable at, right?
Right.
That's out of the way. Value-added services, that's moved from sub 10%. It's moved to around 12.7% as of last fiscal year. Where is this number headed?
Sorry, we lost the voice.
VAS, value-added services. Yeah. As a percentage of your mix, I think it was sub 10%. It's moved to around 12.7% odd. Yeah. Where is it headed?
Sorry, the last word I am not able to hear. Sorry.
Where is it headed, sir? Where is it headed? Value-added services.
Yeah. So value-added services, if you notice, has shown a growing trend. And why it is? Because the customers that come to us, they are buying more and more from us. That is one aspect. For example, if you look at our, like when employees take office spaces, they also buy services like food, typically transport and other services also. So that is where you are seeing an increasing trend over there. And like typically 3 years back, this number was about 9% of our overall revenue. And today it is all 12-13%. So there is a very healthy uptake on that. And the same customers are buying in more. Another metric I will highlight is when customers come to us, they take space in one of the centers. And if they like us, they try and grow to other centers, or they offer us more services. Today, if you look at 44% of our revenue is coming from clients who have taken more than one center from us. And this number was 20% 3 years back. So we are very fast, having a very, very high level of overlap in terms of spaces and services with the clients that we are serving.
Just a clarification, on the area which you're currently managing, I believe it's 6.3 million square feet, right? After utilizing the IPO proceeds, you are targeting to cross 8 million. Is that right?
Yeah, basically, if you see in our business, the capital expenditure has been about 1,500 rupees per square feet. So if we are raising 450 crores, that will suffice for 3.5 million. Plus, we have very good internal cash accruals. So that, and as of now, when I talk about 1st April 25, we have an inventory of 2.1 million square feet of space that we have signed up and yet to get operational.
So what is the total area you're currently managing?
Yeah, so 6.3 million is which is operational, where we are paying rents and collecting rent from our tenants, and all of that is happening on that 6.3 million. Whereas the total signed up space is 8.4 million. So this gives you an idea about the pipeline. That 2.1, almost 33% of the space that is operational today is available as a pipeline.
Right.
Over the next
once you have this money, you will proceed with fit outs, etc. Right?
That's right. Yeah.
At that 1,500 rupees that you said per square feet.
Yeah.
We'll leave it there, but more numbers hopefully when we speak again during the listing. But good luck to you, and thanks for joining us. So lots of co-working sort of business models making it to the market. I think SmartWorks came to the market recently, and of course you have others which are already listed for a while, and I think there are a couple of more coming as well. We'll take a quick commercial break here. Devin Choksi on specific stocks on the other side. Stay tuned.
Oh boy, the stock is at 300 rupees. Now this morning we wake up to news coming from Paytm. Some part of the street was sniffing that maybe they break even, they turn into profit terrain. And that's happened. It's still half of what the IPO price was. Your view on the stock?
Yes, Nigel. Good morning. Well, I think it's happy to note that these companies have started reporting profit, particularly Paytm. For long, they have been promising and they have been passing through a lot of hurdles. I think they have overcome that part of it. Not completely sure about the unit metrics of what exactly has resulted into the number of profit I think that they have created or they have produced in this particular quarter. But as we go through the details, I think we're more sure about it. More importantly, I guess I think even for internal, I believe that I think the higher amount of trust is largely because of the Blinkit story, which is basically giving the larger trust in this business. In my viewpoint, I think the market action or the price action in the market at current level is largely driven by the funds who are basically flush with inflows at this point of time. And as a result of which, I think allocation of money is happening into this space. So I believe that I think everything is in price today. I think they're expensively priced probably. Maybe I think the profit picture will have to be much larger and stronger going forward on a sustainable basis. That could possibly justify this price. But at this point of time, I believe that most of these companies are adequately priced or maybe fully priced at current levels.
Got it. Paytm, Devin, the numbers have come through, and I think the reaction, of course, will show through. But new age companies, etc., you're saying, well, maybe things are adequately priced in. What else out of the results stack that you saw, Devin? Anything which stands out to you in a big way? There is KEI Industries. We'll be speaking with the management a little later. Dixon has reported numbers. Anything stands out?
Yes, I think Dixon has promised, probably, I think, has generated and produced, I think, significantly large amount of profits on I think, almost two times size the profit, I think, what they produced last year versus a one-time increase in the turnover. Not very surprising, though, because I think each and every vertical in which they are operating, they have probably, I think, expanded the capacities. And that was promising to be generating better revenue and the profits for them. Again, I think the business looks absolutely convincing, no question asked on it. Going forward, the visibility is also strong, but everything is in price. Unless I think you get meaningful price correction, I think you are not getting the advantage of buying such kind of stocks in the portfolio.
What about Dalmia Bharat, Devin? Actually, the numbers look good. The stock, though, has run up. And, some of these stocks, earlier it was a bit of a surprise, when you started getting those numbers that trickled in, Novoco came in. But from the highs, actually, that we saw in the result day, the stock actually has come off. Sagar Cement as well, good numbers that came off. Now, the street is bracing every time there's a South Indian company that's going to be coming out with a set of numbers that's going to be reasonably okay. Dalmia Bharat, Ramco Cement, in fact, that as well has done quite well. From the pack, what do you like?
Yeah, I think the cement as a whole, I think, was anticipated to produce better performance, largely because of the higher increase in the prices, better capacity utilization, and at the same time, lower input cost, which is resulting into better amount of profitability, particularly on the fuel cost side. So that is resulting into better profitability. So cement was expected to do well, and as it happens, I think before the result, the market would get the understanding on this subject going, and as a result of which the price would already mature at that time. So maybe profit booking is not ruled out post announcement of result. But as I see it, I think two large companies, the Ultratech as well as the ACC Ambuja combined, which I believe I think are likely to be the bigger beneficiary of this particular move in the cement business, which is likely to be even stronger in the subsequent quarter of the current financial year. So larger the capacity, better the benefit, given the kind of scale on which they are operating. Some of the individual companies like Ramco and Dalmia Bharat, which you mentioned, both of them look promising at current levels. Maybe I think one can even add them into the portfolio as well.
Two more names, Devin, and these are kind of sort of follow-ups from yesterday. Tilaknagar Industries, we reported yesterday that they perhaps are the front runners to buy Imperial Blue. Nigel put that story out. That is one. And then there is Max Financial. Again, a CNBC-TV18 exclusive. Axis Bank wants to buy another 10%. They own 19 point something. I mean, they have approval for 20%. They want to buy 10 more. So just these two names.
So unfortunately, I'm not covering these companies, Prashant, so I won't be able to give more details about, I think, either of them.
I see. No problem. So those were stories that we sort of put out in trade yesterday, during market hours yesterday. What else is on the radar? 361, the block is done. On the wealth side, any thoughts here?
Looks, I think, convincing from a point of view of, I think, the kind of reach that they have created. Not too sure at this point of time, I think, what are the unfolding game plans are. But business conditions remain absolutely very conducive, and I think the growth is seen. We also like, I think, some of the housing finance businesses, because I think the way in which the real estate business is happening, housing finance companies are expected to do better. The bank-promoted housing finance companies are doing relatively slow, but I think the other NBFCs are going probably better in my viewpoint.
All right, Devin, we'll leave it there. Thank you very much for joining us. Short conversation, but punchy. We take a break. Technical trades on the other side. How are things looking?
Yeah. Good morning, Prashant. So I think, as I said, holding on to 24,900 gave us some confidence that we are not breaking down immediately, but there's no sign of a strong reversal on the upside. So my sense is that 24,900, 25,300 broadly would be the range, and the markets might just consolidate between these boundaries. So breakout on either side, will give us some kind of directional bias, and I would say that there's an equal chance of breaking on the downside as much as on the upside. So in that sense, we are, for the time being, neutral on the index, but trading with stock-specific biases.
Okay, an equal chance of the downside or the upside break. Got it. So in neutral territory. Morning, gentlemen. Sudarshan, let's get your thoughts in. Are you trading the index? Do you see anything here, Nifty or Bank Nifty?
Good morning. Well, the Bank Nifty is a buying opportunity on any dip. And I think that's the only index we should be trading in. The Nifty is in a very narrow range. Now, these narrow ranges can do anything. They can actually, the problem is if they break on the upside or the downside, a tradable opportunity will come. But the problem comes if they don't do that breakout at all. We have seen many, many instances in the past when the Nifty has drifted for weeks altogether, 3-4 weeks. This could be one of those cases. So the Nifty doesn't have any trading opportunity. Intraday, you can look for sharp dips for a quick trade. That is intraday traders only. For most positional traders, the Nifty is an avoid. The Bank Nifty remains a buy on dips.
Okay, got it. So avoid the Nifty. If at all you have to trade the index, stick to the Bank Nifty. Got that, gentlemen. So let's talk about stocks. Both of you are more convinced on individual stock trades. So Mitesh, what's on your list?
Morning, Subi. I have Tata Chemicals as a buy recommendation with a stop at 949, 948 for targets of 990. ICICI Bank, after that, getting into all-time highs, closed mildly weak, but it's still above those earlier closing pivots. So buy here with a stop below 1460 for a target of 1500. A sell on IRFC with a stop at 133 for targets of 122, and a buy on Hindalco with a stop at 680 for targets of 710.
Okay, all right. So Darshan, let's get your stock-specific trades as well.
Well, Indigo is a buy with a stop under 5830. Power Grid is another buying opportunity with a stop under 291. I have Nykaa. Now, Nykaa is a momentum stock. You don't actually want to buy and hold it for a very long period. But for the time being, there's an opportunity to buy with a stop under 215. I also have an intraday short. This is my only intraday short, Biocon, with a stop above 395. Remember, shorts are always intraday.
All right. Gentlemen, thank you very much, both of you, for joining us with specifics as far as trades are concerned. I think we're almost hitting the pre-open session. We're about 1 minute away. Leela, Hotel Leela, Bangalore recently listed. Schloss Bangalore is the name of the company. For the first quarter, the company's seen a healthy revenue growth. EBITDA saw a strong 50% jump. They've repaid 2,300 crores from issue proceeds. To talk about how Q1 went and what's the outlook in this quarter, that is Q2, we have Anurag Bhatnagar, Chief Executive Officer of the company, now joining us. Anurag, good morning. Great to see you once again. And good to be talking now that you are, of course, in the listed arena. So we can talk specific numbers, Anurag. How was, if you can tell us, how was July gone? And are at the margin, are things as strong as what we've seen over the last couple of quarters, or is there a bit of slowing?
Hi, Prashant. Great to be here. Thank you for having me. I think before I get to July, let me just give a brief color on the quarter that just went by, which typically is considered a bit of an affected quarter. There were some headwinds. There were some geopolitical tensions, as we all know. Despite all of that, we saw 25% growth in our revenue, a 63% growth in our EBITDA, and almost a 10% margin expansion on the EBITDA. Now, looking at July, our business that we recognize in the luxury segment is very resilient. And we have seen that looking at the macroeconomic indicators, the growing affluence, the consumption for luxury products and services and experiences, and the iconic nature of our hotels, we definitely are looking forward to a great July and as well as this Q2 as well.
So, hi, Mr. Bhatnagar. I'm just looking at some of the internals and they're looking really good. I mean, your top line is 20% growth. Margins have improved to almost 37%. Your occupancy has also gone up. I think you're at about almost 64% now. How sustainable are some of these metrics? Let's start with the margin itself because it's looking very, very smart. Operating margin at almost 37%.
So a lot of investment has happened into our properties over the last 5 years. We have invested in CapEx. We invested in green energy. 51% of the total energy in our hotels comes from green energy sources. There is a lot of investment that has gone into asset management practices and revenue management. We have a new website which is delivering almost 72% growth year on year in terms of both visits as well as in terms of optimization of the revenue. So we definitely believe with all the efforts that we have made and the value drivers that we are instigating in all our hotels, we definitely believe that these margins are very sustainable because we have gotten a robust cost discipline. We have also got synergies within the company and with our promoters to ensure that we get great procurement synergies.
No, but sir, the thing is that I think when we've spoken to you earlier, you've given a rough guidance of mid-teens EBITDA growth. But your EBITDA this quarter, first quarter itself has jumped over 50%. And then, like I said, margins are almost 37%. So do you want to revisit that? Can you give us some sense of full year FY26 guidance for EBITDA growth, for margins and maybe even revenue?
I think our margins, if you look historically, have been extremely high, as you have seen, close to 49, between 49 to 50%. And this is the margin that we are looking at for this quarter and towards the year end as well. And definitely sticking to a mid-teen kind of a EBITDA growth year on year.
50% margin. Okay, got that.
Close to 50%, I would say.
Close to 50% EBITDA margins.
Anurag, what will occupancies be? I think, will they be in this early 60s kind of range?
For the year end, look, this quarter obviously was impacted for a couple of weeks, I would say. But the Leela business is very resilient, as it is in most luxury products and experiences. So we didn't see much of a blip. But we definitely believe that H2 is typically 2x and far more stronger than the typical H1 in terms of financial year. Looking at the business that we have on books, the funnel that we are looking at, some major national level events which are happening in Q2 or H2 of this year. And plus, I want to draw a perspective. Nearly 50% of Leela's business comes from international markets. And international business is still not caught up on pre-COVID levels. We are expecting going forward in H2, a lot of inbound business coming in based on the queries that we are receiving and the interest people are taking in India as a destination and Leela as a product.
International business, Anurag, is the percentage of mix. What was it earlier and what is it currently?
It's hovering between a 50% mix.
Okay, all right. And pre-COVID, you said?
Pre-COVID, it used to be nearly 65 to 70% of our mix. But we see this growing influence in India. Our products that we have created in our resorts in terms of family villas, kids play areas, reinvestments back into food and beverage and new venues and new spas. Our domestic consumption is growing. So now it's hovering around 50%. Plus, if in terms of international arrivals, if you have the statistics with you, they still haven't caught up with the pre-COVID levels. But for us, we are expecting based on the funnel and the expressions of interest in terms of international incentives, delegations and FITs, a strong rebound between October to February, March.
The big pull factor, the kids' play areas, I'll tell you what, I look out for them. All right. Your EBITDA target you have given of around 2,000 crores, right? By 2030. That's the aspiration. Can you hit 250 crores of PAT, say, in 27, 28? Would that be a possibility?
Hopefully, at an annualized run rate, we should be coming close to a 400 crore of PAT. But that being said, there are 4 major levers in which we are looking at, and I think we have already declared that yesterday in our earnings call. We see a lot of leg room and runway ahead in terms of same store growth because of the iconic nature of our hotels, which we own, as well as the markets that we operate in. There's a huge delta between demand and luxury supply. And secondly, based in terms of the business that we see coming into India and the growing affluent base to consume luxury.
Yeah. Now, we've asked you some, long-term questions. I must ask you a very near-term question as well. If you look at average room rates, they've been trending higher, right? I think you're closer to, FY25 overall, you were just above 16,000. How much higher do you see average room rates heading, especially as we get into the busy second half of the year?
So I definitely believe that the Indian, if I give you an industry perspective, we kind of call the room rates as higher in context to what we have been historically seeing. Now, Leela has been historically growing at a high double-digit ADR over the last 5 years at a CAGR. We definitely believe we are going to maintain that momentum for a couple of reasons. I spoke earlier where our hotels are located.
Right. Anurag, we're short on time. So 18,000 rupees or so was Q1, right? For the quarter. Right. Roughly their ARRs. Where do you think H2 you'll kind of sort of maintain this? This is the flow we should work with for the rest of the year?
We are definitely going to improve this significantly in H2. This was like the first quarter, as I mentioned earlier. H2 is much stronger and much more robust in terms of inbound.
So 20,000 plus?
For sure.
So F5 26 over 25 ARR would be up how much?
We will be looking at close to a double-digit growth in our ARR and maintain that. In the first quarter, we have grown 13% on ARR. We are likely to continue with the same trend for the full year as well.
You're adding 7 new hotels, 7 new properties, all managed?
No, actually 8 new hotels coming in our pipeline, out of which 6 are going to be owned and 2 are going to be managed. We have an active pipeline of 966 keys, and I would like to draw your attention that we are going to be coming back to Mumbai in a big way in our property in BKC. We got an iconic location in the G block in BKC, and we're going to come up with the Leela Palace, Mumbai. We already closed the transaction in this quarter, and we are getting into design development and the next steps.
Oh, wow.
Just to reconfirm that 400 crores of net profit by 2030 or 2028?
400 crores of EBITDA is an annualized run rate. 400 crores of PAT is an annualized run rate PAT that we are looking at starting from literally this quarter.
Of PAT, so there'll be 100 crores per quarter from which quarter?
Looking at starting from H2 onwards for the next 4 quarters, we're looking at 400 crores. So FY26, FY26, 400 crores. I mean, basically, next 4 quarters, essentially 400 crores.
Should be around 309 crores because you've done 9 crores of PAT in the first quarter, and you're saying that from year on you're going to do 100 crores of net profit.
So I tell you, the first quarter was impacted because the IPO came live on 2nd of June. So we serviced our debt and paid down our debt significantly. So first quarter is not a kind of a reflection on what the future quarters are going to be. But we definitely believe that us having paid down and having a very strong balance sheet, and our net debt to EBITDA is now 0.3x, which is significantly very low. So we definitely believe that having pared down our finance costs significantly, our next few quarters of PAT is going to be high, much higher.
100 crores per
Actually,
quarter.
Nigel, the numbers, I'm looking at, this is a JP Morgan report. Force, the number, I think they'll be far higher then, right? I mean, rolling next 4 quarters, Anurag is telling us 400 crores in net profits.
Yeah.
So, that's a big bump. Anurag, thank you very much for joining us. Good speaking with you, and good luck as you sort of go into H2. Significantly better. Seasonally, it's much better for the hospitality industry as well. Let's just bring in Sudarshan and Mitesh back into the conversation. I think it's 9:10. Let's get their calls. Mitesh, what do you have?
I'll go with the buy on Tata Chemicals for targets of 990 plus.
Okay, and Sudarshan?
Well, look to buy Indigo with a stop under 58.30.
Okay, all right. Indigo it is. By the way, thanks very much, gentlemen. By the way, the pre-open has settled, and we are set for what looks like an 80% pop at the start. Reliance is finally managing a bit of a recovery. Remember, first half of this week, Monday, Tuesday, Reliance has had a bit of a rough ride. Let's see. And some of the banks like ICICI Bank look like they'll march northwards as well. Paytm is on the radar. The company has turned in a profit at the net level as well. So Is the worst over or not? There's a great bull and bear argument on this, and Gaurav is bringing us that argument. Gaurav?
Well, yes, Paytm definitely reported good set of numbers, and now there are two sides to these numbers as per brokerages. First, let's talk about Jefferies. They have upgraded the stock to buy and also raised the target price to 1250. What they're saying is that the EBITDA was actually a beat in terms of the expectations. MTU, which is monthly transaction users, the number actually growth was at around 3%. It is encouraging. But from here on, what they are saying is that the contribution margin will stabilize as per them. What they are also highlighting is that when we look at the valuation now, it is at a discount to the company like PB Fintech, which is actually attractive as per them. And also they believe that this is going to be a compounding story. On the other hand, we also have Citi, who actually increased their target price to 1215 rupees. On the bear case, we have CLSA. Now, they have also highlighted a very interesting point here. They have actually downgraded the stock to underperform, although they have increased the target price to 920 rupees. What they're saying is that the company, again, there was a beat, definitely, if we compare it with the expectation. But the one key point that they have highlighted is that in the loan distribution business, Paytm has discontinued their default loss guaranteed program with one of their largest lender. Now, what it means is that the upfront cost in the results from the DLG was not there, but at the same time, deferred revenue that was booked in the last quarters was there in terms of revenue, and that is something that is hurting as per them. Lastly, what they are also saying is that there will be some quarter where we may see some kind of sluggishness in the revenues. Now, Macquarie also maintained its underperform rating and a target price of 760 rupees. So definitely two cases here for Paytm. We will definitely watch on how investors are going to treat Paytm today, but definitely from the brokerages, we are seeing two cases.
Okay. All right, well, for the time being, I think the bulls are having it because in the pre-open, Paytm is managing a 3% up move. Thanks for that, Gaurav. Let's quickly revisit Colgate as well. Colgate, of course, declared numbers yesterday during market hours. Stock was fairly tepid. What's the sense now, Mangalam? So management commentary, brokerage indications coming through. So put it all together for us.
It's fairly weak. Colgate weak set was expected. The stock has been an underperformer, down nearly 40% from its highs. And the management commentary isn't inspiring much confidence either. So you have the management saying that weak demand, high competitive intensity and a high base led to volume decline in this quarter. They do expect recovery in the second half of this year. That too will be gradual. Brokerages on the back of that. HSBC has a hold call, cut their target price to 2,600 rupees. They're saying that improvement is anticipated, but structural growth potential remains low. Nomura too has a reduced call. They have a target price at 2,350. They expect the volumes to have declined 3 to 4% this quarter as against street expectations of growth of 0 to 2%. Goldman Sachs as well has a sell call, target price at 2,300 rupees. They've paired their FY26 and FY27 estimates by 3 to 4%. Citi too, sell call. They've cut the target price from 2,300 to 2,175. They're saying challenges likely to persist in the second quarter as well. Nomura is the sole buyer here with a target price slightly upwards of 3,100 rupees. They are expecting recovery in the second half and they anticipate the volumes to have fallen just 2% as against, again, expectations of 0 to 2% growth.
Okay, all right. I think we're just hitting market open. Mangalam, thanks very much for that. So let's just do that. Let's look at market opening in terms of rates that come up, and then we will, look at individual stocks as well. So it's a good open, 80 points higher, back at basically where we were at highs day before yesterday. 25,140 or so is where we are at, and we'll see if these gains are sustained through the course of the day. Early signs of recovery, but it's got to be backed up by price action, which so far we've not seen. Nifty Bank is up a little bit as well. Mid-cap index is up 0.18. Small-cap index also coming up on your screen. But I think it'll be stocks once again this morning. Paytm and Credit Access and a few others, which we've been highlighting. What do we have? First rates starting to come up shortly, and it should be higher. We'll look at the heat map and then quickly move on to individual names. What do we have? 67 points on the Nifty, 195 on the sensex. So 25, 120, 58, 810. That's the Nifty and the Nifty Bank respectively. Small cap indexes, I think starting, that rate should move. It's on the small cap index. Mid cap index is absolutely flat. The small cap index is almost unchanged as well from yesterday's close. So it's large caps doing a little better, 0.25% each, but broader markets are finding their feet. Heat map should give you a sense of how Nifty stocks are opening up and down, and then we'll take it from there. It's bulk of it, starting higher. I mean, you've got about 5-6 names which are starting in the red at this point in time. Surbhi.
Actually, I started looking at the Eternal stock first. Let's pull up Eternal. It started lower because, I mean, after a 15% rally, some profit taking is expected. But the moment there was a little bit of a, couple of rupees of a downtick, it got bought into. That's the sense for demand, and now the stock is flattened out. Anyway, let's talk about the winners on the Nifty this morning. Nestle India, 1% higher. Bharti Airtel, about 0.7% higher. Infosys is approaching numbers with, well, some sense of optimism, 0.5% up on Infi. HCL Tech is also managing a little bit of a gain for what it's worth right now. There is Tata Motors, which is up and about. Bharti Airtel. Bajaj Finance is managing a 0.5% up move. Shriram Finance, 0.5% up. L&T, 0.5%. So, all of these batsmen are chipping in with only a few runs here and there. No one's scoring the sixers and the boundaries. But little runs are coming in here and there, which is how the overall Nifty tally is about 70-odd points. Reliance has stopped dragging at least after 2 days. So that's big help. 0.5% up on that stock. TCS for what it's worth, 10 rupees adding up to the board. ITC, so likewise, it's a lot of stocks chipping in with little bit here and there. And no major declines on the Nifty, at least so far this morning, which is good news for the bulls. So like I said, Hero is down but 0.25%. No Nifty stock is down more than 0.25%. It's a good-looking Nifty screen. And everyone's chipping in with a few runs on the board. So the overall tally is about 70 points now.
Well, that's right. The stocks are in focus. I think Lodha as well as Oberoi, those large trades, it appears, I think that should have probably gone out of the way because Lodha is down close to 5%. There's a big volume out there. So, that one has probably happened. Get the chart up for you. Even Oberoi Realty, that one as well. So 4 and 5% because of those large trades on both those two names. Blue Jet, that was a stock that was down 10% yesterday. It's down another 5%. So post its numbers, remember, these are one of the stocks that in fact had a very, very big run. And now, in fact, it's coming for some serious profit taking. I'll tell you what, after yesterday's 10% cut, after today's 5% cut as well, still the stock is up 50% for the year. So it seems the street either miscalculated or it appears the stock has run way ahead of itself. So keep an eye out on that name as well. What else? JSW Infra, well, that's one of the notable winners in today's trading session. So that's doing fairly well from the broader markets itself. Godfrey Phillips, let's pull up that stock. Philip Morris came out with its set of numbers overnight. The stock actually was lower. But, the commentary on the India business actually was a little bit encouraging. For the time being, the stock flattish. Volumes are a little bit higher than what we normally see. So keep an eye out on that.
SML is also, by the way. Remember, we were talking about the stock yesterday as well. 5% up on SML again this morning.
I don't know if my screen, but Religare is up 10%. It's got a... I think we just put up Religare if that is indeed the case. Yesterday, the Religare stock was up
1%.
Okay, my
just
fault.
refresh.
I don't know what my screen is showing. It's showing me 314. But
Credag,
so that's why I
by
said
the way.
maybe we'll have to just give it 2 minutes more. Credag is, we should pull that up.
It's rising now. It's rising because I think some of those credit costs and asset quality issues, at least they've not been bad. In fact, they've done well this quarter, though at the profit level you can argue, but I think there's some buying on Credag from lower levels.
Absolutely. And this is the MFI space beaten down. When will turnaround happen? I mean, out of the lot, Credit Access has always been considered as the highest quality name, but it's also taken a bit of a battering over the last 2-3 quarters with a lot of problems starting to appear. We'll sort of address more names in just a bit. Dheeraj Agarwal is Managing Director at Ambit Investment Managers. He's with us for a quick chat. Dheeraj, good morning. Great to have you with us here. Thanks very much for your time. And just sort of kick us off with your assessment of earnings, especially from financials and outlook here. Which part of financials do you like? Because that is where you've got generally there is tailwind of, I don't know if it's helpful or not, but on the institutional side, people are bullish. I mean, people want to own financials, and everybody's got their own spots: gold finance, NBFCs, large private banks, small. So there's a fair bit here. On the other side, you also have the RBI, at least trying to prime growth here, kickstart lending in a big way. It's languishing at about 10% system wide, and they really want that to move higher. So let's just start with that space, Dheeraj.
So financials results in general are pretty decent, especially the large banks. And that space is interesting because there are no issues or negatives in that space at this point of time. So the NPL issues are very much under control. There is no credit crisis in the country. The only issue at this point of time in the financial services sector is that the loan growth, as you rightly said, or the credit growth is a little weak. It's come down to 9 or 10%. At this point of time, the market is expecting or hoping, depending upon which camp are you in, that the credit growth and the economic activity will pick up starting second quarter of this year, and more importantly, in second half of this year. Now, the great thing about a forward-looking positive expectation is that the current weakness, in some senses, does not matter, right? Because it's sort of priced in, it's expected. So the current results are pretty much in line with expectation from that point of view, that the credit growth numbers are tepid, but all other metrics are quite good. There are hopes and expectations of a credit growth and the economic activity pickup going into second quarter. That, to my mind, is the most crucial variable which will determine whether the rally continues or stalls. But it's, I think, a few months away for that judgment call.
Dheeraj, hi, morning. I'm just going back to a conversation we were having with Drew Pettit, who's the strategist for Citi. And as we all know, Citi has just downgraded India recently, right? Yeah. He made a very strong argument because on one side you have foreigners who are saying India is not expensive, earnings are all right, just about okay. You've got other markets like South Korea, China looking better. So they're allocating money there, they're selling here. And then you have, of course, the Indian market because of the domestic flows being strong, that SIP book being very strong. I mean, India, I don't know when India will ever be cheap because there's so much of local money buying Indian stocks. Yeah. So then we're in a bit of a funk, aren't we? Because the FPIs are selling, domestics keep buying, and we remain in a range. I mean, how long do you think this will last?
Yeah, so the FPIs will come back in only when earnings growth accelerates. So, whichever way you actually cut it, the current expectation which the market has that from September quarter, we will start seeing inflection point for earnings growth to start picking up, and second quarter will gather pace, are the most crucial variables which will determine whether the rally continues or not. So at this point of time, you're right. There's a tussle. If you look at the last 12-month performance, right? I mean, US S&P 500 is up, I think, 13 or 14%. Nasdaq is up 13. India Nifty is up just 2% in US dollar terms in the last 12 months. Germany, Korea, Taiwan, even UK has done better than India. So what you're saying is absolutely correct. And for accelerated move in our market, we need FPIs too, in addition to the domestic money. And that, to my mind, will chase earnings. And for that, we might have to wait till September quarter.
I was just thinking, folks, we haven't used the word melt up in such a long time, right? Prashant, when was the last time you used melt up to describe the Indian market? For old time's sake, at least it should come back, no? I mean, that phase or that sense of absolute golden euphoria. But I think we're still waiting for it now.
Well, that's right. Hi, Dheeraj. Good morning. I want to ask you about a stock. You want to guess which one?
Yeah, of course. It's done very well in the last 3 days.
Is it done and dusted, though?
No, I don't.
Do you think bulk of it is in the price? By the way, I mean, for
those
who are not...
Which stock are you talking about?
It's Bato Eternal. We have been talking about it from 100, 120, 150, 200 rupees, 300. So it's not just for the, for clients now. As a customer, you're not going to be only happy. Shareholders as well who got in, they'll be very happy. Tell us what's the outlook from here on?
So our team is still very confident on the stock, and it's one of the core holdings in one of our flagship portfolios in asset management. We still believe that the hyper growth journey for this company continues. The market leadership position continues. People keep on getting worried a little bit every time some new player or even an existing player launches the quick commerce business, saying competition is heating up in the space. But I think by now, leadership is very well established. So even if some competitor and some other players come in, it probably will compete versus each other and not really threaten the numero position for this company. So till such time the hypergrowth continues, and for that there is a long journey. I don't think there is one should be in any rush to change the view on this one.
Almost 3 lakh crores in market cap, Dheeraj.
Interesting, very interesting. It's larger than a number of very well-established old economy stocks now. But that's the way the world is moving. Look at all the mega caps in the US. I mean, they're all sort of new economy players.
Yeah, absolutely. And we'll see what this goes. But so, I mean, such divergent views on this one, right? But I think more and more people are sort of throwing in saying, well, must have this one because he's done well. And gains get more gains in that sense. What about Dheeraj? What else? I mean, Paytm, any thoughts?
I don't have a very clear view on this one, but just browsing through the results which came in last evening, it seems very encouraging. But I don't have any concrete view on this one.
Okay. So, Dheeraj, what else? I mean, we've discussed Zomato. Where else? This market is so hungry for growth ideas, right? Look what happened. Ixigo, the lead Travenues Tech, that stock Ixigo, they reported numbers and growth was good. That stock went up, 20% in a matter of 2 days after numbers. And that's the thing. There's such appetite, such hunger for growth stocks. Do you see anything else on the horizon? The wire and cable guys, for instance, they've done well this quarter. What else are you keeping on your radar?
So, the reason for that at a slightly higher level is something which I mentioned on the channel the last time I came here as well, that earnings are getting very, very polarized. As this is a very different phenomena from, let's say, FY22 to 24, where earnings was more widespread in the sense that a larger group of companies, a larger number of companies were able to deliver growth. And as the economy has slowed down a little bit, there's a risk that global economy will also slow down, looking at everything which is happening in the world right now, either on the trade front or geopolitics front going into next year. A very small bunch of companies will actually deliver growth. So this environment will end up becoming sort of similar to what we saw between 2015 to 20, where only a handful of companies were able to deliver strong earnings growth, and the entire pool of money just kept on chasing the same stocks, and the valuations became astronomically high. So I see a repeat of that over the next 3 years. I think widespread earnings growth environment is over for the time being. And like the couple of names that we discussed right now, we will have to hunt for few individual names where earnings growth is actually fantastic and the quality of earnings is good. We have to beat the market.
But Dheeraj, that's precisely what I'm asking you. That's why I'm asking you. Give us some more names, some more clues at least, because it's not easy to make money in this market anymore. So help us out here.
Yeah, I mean, I generally prefer to avoid giving names, as you know, right? So
okay, clues at least, sectors, clues,
in fact, sectors, you'll find winners in all the sectors. So like we started the discussion with financial services. So a few of the large private sector banks are clear winners out there. The quality of earnings is good, valuations are not that stretched. There is a fair bit of logic to say credit growth and economic activity will pick up in the second half of this year. So that's one very, very clear space. Very select consumer discretionary names, if demand does come back in the economy, buoyed both by interest rate cuts as well as the tax benefit which was given in the last budget, which will now trickle into the hands of the consumers starting this quarter. There'll be winners in that space. I mean, Eternal is one such example, which is benefiting both from a micro as well as a macro tailwind out there. So you could find winners in these spaces. Some financial services, specific consumer discretionary, autos, very, very worth watching very, very closely. Demand has been weak for a very long time. Let's see if the interest rate cuts spur a demand growth back into autos as well.
Okay, all right, Dheeraj, not letting out names, but one space that has been disappointing is old tech. The earlier darlings of the market. Now today, all eyes on Infosys, because from the large cap names that will at least grow, and in all probability we'll see a revision in their guidance. How are you placed out there? Because my director is going to pull up a chart. It's actually underperformed even the Nifty. Your take.
I'm still slightly cautious on this space. And again, when I say cautious, I'm saying broad brush cautious that there could be individual names which could shine in the space as well. The reason being, I think everything which is happening in the US, whether there's a deep slowdown or a shallow slowdown is the only debate in my mind, but there has to be some deceleration in the economic activity and growth in the US going forward. It's not possible that with so much of trade barriers, tariff controls, XYZ and the other, growth can actually accelerate. So IT space being directly sensitive to what happens in the US and US economy could actually be in a slow growth zone for another year and a half. So I just continue to be cautious.
By the way, Nigel, Infosys will report, but so will Coforge.
That's a stunner.
That's the one to watch out for. Coforge stock should come up on your screen. Out of the pack, IT pack, I mean, just look at expectations.
Yeah.
This is the one which I think has got highest growth expectations. And last few quarters, I mean, it has actually beaten what the street has said. So just keep an eye on this.
And just to close the loop on Eternal, in terms of market capitalization, 3 lakh crore and the 28th most valuable company on the BSE, the top 100 market capitalization company. So what a journey out there.
I think Coforge, I would rank as probably last 3-4 quarters, the strongest management commentary on the street. I think the only one that comes close today is the management of Schloss, Bangalore, Leela Hotel, sounding as confident about their business, 400 crores in profits this year. But anyway, these are the kind of stories that the market is really, really hungry for and willing to reward. Dheeraj, thanks very much for the conversation today. Great chatting with you as always. Wish you a good day and we look forward to connecting again soon. Okay, let's stay with the earnings. Markets holding up, actually. Markets been pretty okay so far, though the mid-cap index is flashing some red, so watch for that. Nifty still holding on to a 50-point gain, but mid-caps are a little cautious. Now, we're staying with earnings and putting the spotlight on KEI Industries, and it's been a good quarter for KEI, especially their wires and cables business, because overall revenue is up, in the 20s, but if you look at the wires and cables part of their business, then that has surged 32%. Margins are in line with street estimates, though, there's a little bit of a pressure that's coming over there. So let's discuss all of this and more with Mr. Gupta, who's with us now. Sir, great to have you back on. And another solid quarter. We're just discussing this with our market guests that I think wires and cables at least is one segment where the market keeps getting growth. And you've done so well, right? You're best in class, 32% growth. Now, just tell us, what does this reflect? How does this reflect on your full year projections? Because your first quarter has been so solid. Would you like to increase your full year guidance, overall revenue guidance, or maybe the wire and cables guidance?
Yeah, good morning. We will still be very cautious. I think we will continue with our guidance of 18 to 20%, although we will definitely try to aim better. The first quarter has been extremely good. We have grown our export of wires and cables by 122% compared to last year. It is the actual growth is 61%, but it is due to decline in the export of EPC project, which was there last year, but now it is not there. But the wire and cable growth is substantial.
On EPC, can you just tell us, that business has been weak. So the revenue is down 56%. EPC margins also under a bit of pressure. So what's happening there? Can you just specify and give us some numerical guidance as well on if it picks up in Q2, Q3?
No, the EPC business we are consciously bringing down. We are not taking new projects, and our aim is to limit it to maximum 3 to 4% of our total sales. So this has been a conscious decision 4 years taken back 4 years back. And we are consciously closing the contracts and bringing down the business as we are not taking new orders.
And by when will you get to that? This reorganization or this shift in focus, more on wire and cables. By when will you reduce EPC to 4%? So this whole exercise will be complete, just so that we know.
We have already reduced it to that level. So we want to keep it maximum within 400 to 500 crore level a year.
Okay.
Mr. Gupta, you continue to beat what you say you will do. Good morning. 18 to 20% though revenue growth is maintained, but 25% growth this quarter. So, and you're saying you're confident of maintaining growth rates. The big, at a high level, the concern broadly for the sector is the simple question: have margins in the wire and cable segment peaked? Will there be pricing pressure because what new competition is doing in terms of setting up capacity over the next, it's already underway and will go on over the next 2 or 3 years. And that's a lot of new capacity, some 75 to 80,000 crores being put in. Will that cap what margins you can make in wires and cables and have margins which are healthy? Have they peaked here?
Prashant, first of all, I think from where this figure of 75,000 crore capex comes, I don't know, because that much of capex has not been planned even in totality by most all the companies. Secondly, the whatever capex will come, maybe 8 to 10,000 crore in next 2-3 years. Market is also growing, and I think there will be enough room. I think we will be seeing more growth in this business because government capex is growing, and I think private capex will also come up strongly. So there will be enough room for the growth for everyone. Our focus will remain on domestic market as well as export market. I continue to maintain my guidance that we want to take our export to 20% of our total sales within next 2 to 3 years as our new capacities comes on board, which is coming up by mid of this year and then by the next year.
So you say revenues will grow. There is absolutely no doubt. The market itself is growing. So it will get absorbed. All this will get absorbed. But even on margins, you're saying, I mean, there's no reason to imagine that there is a cap.
No, I don't think. And I think we have given a guidance of around 11% EBITDA margins. We'll definitely try to improve it by 0.5% to 1% as our economies of scale comes up, new capacities comes up. We are more established in Western markets. So we will definitely aim to grow the margins. But as of now, I will still maintain a EBITDA of 11%. For next 2 years.
All right. Hi, Mr. Gupta. Good morning. And the numbers look fairly okay. The wires and cables business, if I compare you with your peers, whether it's with Polycab or with Havells as well, in revenue terms, you have actually outgrown them. Margins are relatively lower. My question to you is, are you outpacing industry growth and have you gained market share in the wires and cables business?
I think you must have seen that our export of wire and cables has grown by 122%. It is more than doubled compared to last quarter. That is the reason that we have outgrown the industry peers in our revenue.
All right. So in the domestic market, actually, your market share will be more or less stagnant. Is that correct?
Yes.
All right. Do you have a number handy as per your calculations?
No, I don't have immediately handy numbers.
Okay, all right. Could you tell us, going ahead, what kind of a capex outlook are you looking to put out at current utilization levels? What is it? And give us a sense about how you plan on adding capacity.
This year, we expect to spend around 900 to 1,000 crore capex in our Sanand plant. And the next year, again, this capex can be 600 to 700 crore. Because by the time we complete the project, we will be also doing another capex in the other lands which we have acquired, and it may be for the increase in the capacities of existing products or for some backward integration as well.
Mr. Gupta, I just want to come back to that margin point. And interesting to note that you're sticking to your guidance of touching the 11% EBITDA margin mark this year. And that'll be interesting because the last couple of years, the margin has been hovering between 10, 10.5. I think the last it was above 11% was around FY21. So just give us some more color. What is the kind of price hike that you will plan to take, if any? I think there was one taken towards the end of the previous quarter. Will there be need for more price hikes? And also, since you're going to grow your export business to 20%, how do the margins compare between the domestic business here and your exports?
In exports, the margins are slightly better. That is why I say that we will be able to improve our margins. Secondly, as we start our Sanand plant, we will have some improvement in the margins because of the logistic costs on imports and exports, and also on the incoming raw materials. Because many of the raw materials are procured from Gujarat, or many of the raw materials are coming through imports. So our inward freight cost and outward freight will be lesser, which will definitely improve some bit of our margins.
Okay. All right, Mr. Gupta, we'll leave it there. Thank you very much for joining us. Good speaking with you, sir. And appreciate your time here. Good luck. So, I mean, margins, keeping it at about 11% is the aim. But Mr. Gupta did say we'll aim to improve those EBITDA margins by between 0.5% to 1% or so. So interesting chat there. Nigel.
Just one more point I want to make, from the broader market, so the headline index is a little bit nervous and the mid-cap index has moved to the low point of the day. Bombay Dyeing was a stock that we had highlighted, a week or so, that we're seeing very, very large delivery-based buying out there. The volumes this morning are massive, it's, I think, more than 50 lakh shares out there and the stock is flying away. We'll try to check out more, but we had highlighted that the stock was moving on very, very large volumes and very, very high delivery-based buying. For the time being, shooting up more than 8% as we speak. So just thought I'll highlight that one.
Absolutely. So just a few names, right? I mean, there are some reversals happening, as Nigel said. Market breadth is turned. About 1,450 stocks are lower and about 1,024 stocks are higher right now. Lodha, of course, block we highlighted. Paytm is down 2%. And there is Oberoi Realty down 3.5%. Tilaknagar, which went up like a rocket yesterday, is down about 4%. Blue Jet has been, again, I mean, yesterday was a sharp cut. Blue Jet is down another 3.5% right now. PNB Housing, Patanjali, M&M Finance, Iron Exchange is another, I mean, it's a water treatment company. It's down 9%. And it's got decent sized volumes, by the way, about 491 on Iron Exchange. I mean, I hardly ever remember mentioning this name, but it's got volume. So just making a quick mention of it. Let's welcome in our next management. Dixon reported numbers yesterday. First quarter performance was in line with expectations. Revenues are up 95%, a jump driven by the mobile segment. Now, the share of mobile as a percentage of the overall pie has increased quite a bit. Saurabh Gupta is Chief Financial Officer at Dixon, joining us now. Saurabh, good to have you with us here. Thank you very much for joining us. So, just the basics out of the way, based on what you've reported for the first quarter, right at the outset, what visibility do you have for the full year FY26, Saurabh, in terms of revenue growth?
So, Prashant, I was always expecting this question from you. Yeah, so my sense is, quarter two looks, the order book for quarter two looks very healthy, and it's also the festive season, ahead of the festive season. We feel confident, Prashant, that at least a 45% kind of a growth is definitely doable. Yeah, there can be growth, can be marginally lower and higher than that, but broadly 40-45% is something that we are targeting for this financial year.
And margins, Saurabh?
Margins this year, Prashant, should be on a similar levels as last year. But we expect as and when our component foray, the components come into the system, then the margin expansion will start to happen. But this year, the margin should be almost similar to last year.
Okay. So same margins like last year and about 40-45% revenue growth for the full year.
That's right. That's right.
All right, got that. Within the revenue pie, Saurabh, hi, morning. Can you give us, by the end of this year, what will the breakup look? Obviously, mobiles is a huge segment of it, especially this quarter, because you keep executing these large contracts. But then the laptop business is also coming along, the other, personal devices business. So by end of the current year, what will the revenue mix look like?
So this still large part of a contribution will come from mobiles this year. I think so. Laptop will start making meaningful contribution only next couple of years. This year it will be a smaller number for laptops as we are ramping up. We are expanding in a Chennai plant, and also our JV with Inventec will only come up by Q4 or Q1 of next financial year. My sense is those numbers. So large part of contribution will still be coming from mobiles. That's where we have the largest opportunity this year, and followed by telecom, I would say.
Okay, and what about segments like lighting, other appliances? I'm just trying to get a rough revenue pie mix, in a percentage sense. Should we assume that 90% will still be mobiles?
Almost 80% will be mobiles, 75 to 80%. The way we report is mobile and other EMS division, which also includes your IT hardware, also includes your telecom. So telecom vertical for us will be closer to 5,000 odd crores, which will be broadly 9 to 10% of our revenues. And but mobile will be the largest contributor. Lighting, our JV with Signify should be operational in the first week of August. So once the JV is operational, we expect to get more product categories from Signify for the Philips brand. Gradually and slowly, we'll keep getting some export opportunities there. So yes, the lighting revenue should see an uptake. Our refrigerator revenue should see a significant uptake this year because we are expanding our capacity in direct cool and also adding more product categories. So that will also start making meaningful contribution in the next couple of years. But mobile will be the largest piece for us this year.
So FI, all this washing machines, telecom, lighting, IT hardware, all basically starts to show up in size FY27 beyond.
FY27 and beyond, right. Absolutely, Prashant.
On electronic components, we've spoken about this quite a bit and how that kind of helps you improve margins. Have you that subsidy scheme, what's the status?
Yes, so subsidy scheme, we expect to file our applications under the ECMS category. The deadline is July 31st. So we have already signed up the JVs on the display side, on the camera module side, on the mechanical side, on the precision component side. So we'll be filing our applications in the next 7-10 days before the deadline of 31st of July. And then, yes, the camera module, since it's an Indian acquisition, Indian company, which is already operating in India. So we plan to close the definitive agreements in the next couple of months and hopefully start consolidating by Q3. As far as the precision components, mechanicals and metal parts is concerned, it will require the Press Note 3 approval, which should take another 6-7 months. So hopefully the number should start reflecting by next financial year. And our display, the construction is underway right now. And the mass production should happen only by Q1 of next financial year. So next financial year, we are expecting at least a 120, 130 bips margin expansion, net of the PLI impact that will go away. And by 27-28, there will be further ramp up and stabilization of all these components. So I think so the margin expansion can be slightly better in FY 27-28.
Okay, Saurabh, we haven't, it's been a while, we haven't spoken about the semiconductor plans, and the facility that you were looking to set up in Noida under the semiconductor mission. Can you update us on what's happening there and, how much money you've committed as of now?
So, Surabhi, we are still awaiting for that ISM2 approval of the government, which, of course, has still not yet come in. So we have already tied up with HKC for the display modules, and getting into a fab with them will be a natural extension for us. But we'll wait for the guidelines because since it's a large capex, we would need that support from the government, both from the central government and the state government. So if 70-75% of the capex as part of the policy guideline is committed by the government, then we'll be between both our partners, us and the HKC, will be willing to put in the balance 25%. So we are still awaiting for that approval. My sense is it will take some more time, I would say, for the government.
Is it right? There were some numbers floating that this could involve, this facility, including the fab, could involve a capex of 3 billion. Is that right? So, and you're hoping that the government kind of pitches in with 75% of that?
That's right. That's right. So 3 billion and our outflow would be 750 million. And within that, the partner should put in, say, 1/4 of that. So Dixon's outflow should be 500 million, which should happen over a period of 3 years because this is a large, big gestation project. This will take a couple of years to 2-3 years to come in, which we feel confident seeing the balance sheet and seeing the earnings visibility that we have and the growth that we have. We feel confident that can be funded from the internal accruals. And even if some debt is required, our debt to equity is hardly there. It's almost negligible. So we can always take some little bit of debt, but large part of it can be funded from internal accruals. But that can add a significant more to our business because that is not only for mobiles, that is also for notebooks, that is also for LED TVs, and also for automotive displays. So automotive displays is also something that we will be getting into very shortly in the next couple of years.
Sorry, Saurabh, the fab is that you're talking about, that is for what?
So fab is so as of now, Prashant, we're getting into the display modules.
I see.
Which is part of the component PLI, which is again with HKC. Fab is another one level more extension by getting into the display, absolutely display manufacturing, which would include the semiconductors and the other deepened manufacturing process. So HKC has a fab in China. So if the government comes out with a policy on ISM2 with a committed budgetary outlay, then we will look into get into that.
ISM1, I think there were four awarded, right? 4 companies were given.
Yeah, it was given to Tata, CG Power, and I think so
Keynes was one, and there was one more.
That's right.
But but under that there is no. I thought there was some more which got spilled over, and there are still limits left out of what the government said it wanted to allocate.
I think so. The budget was exhausted, Prashant. That was a $10 billion commitment from the government that was exhausted. So we are hoping that another ISM2 should come in because any semiconductor or display is a very critical component which goes into any electronic product. So, of course, our play will be more into the display fab. So let's wait from the government to come that, and then we will finalize our plans on that side.
Okay, just one thing just to go back to the phones, basic bread and butter, what percentage of what you make here is exported, Saurabh?
So this year exports will ramp up significantly. Last year we were at 1,700 odd crores out of 39,000 odd crores. This year we hope to do an export of closer to 7 to 8, anywhere between 7 to 9,000 odd crores. The first quarter number is already 1,700 odd crores. And one, of course, for an anchor customer to US markets, where clearly there's a big arbitrage now. And secondly, for another customer, which is also our partner, we are working on a large export order to Africa markets. So let's see.
So just to again, since percentages help us understand this very simply, exports as a percentage of your total revenue this year would be how much? And exports to US as a percentage of the pie would be how much this year, Saurabh?
Yeah, so large part of this 8,000-9,000 crores will be for US Surbi. A small part will be for the other brand for the Africa markets. But we see that number growing in the coming years. So all put together, my sense is if last year that number was 5% of our revenues, this year broadly that number can be 14-15% of our revenues, if not more.
Okay. By the way, you're also doing a joint venture with the, in your telecom business. Apparently, that's something you mentioned something in the call for again some high-end perhaps a tech collaboration. Can you just give us some more details there?
So Surbi, those details are still in the works right now, and I'll be able to share that. But yes, it will be for another electronic component, which is part of this electronic component scheme. So yes, hopefully you should hear some more announcement from us on the telecom side. It is a component which goes into data centers as well as for telecom products. So we are working with a company which is very big into that and has a very good technology on that.
And Saurabh, I'm sorry, back and forth, I forgot one point since we were talking exports. Now, especially with your US client, we still don't have final contours of a deal. If you look at our regional markets here, so between 15% Japan, some are at 20%, South Korea is at 25%. Now, if the final tariff for India ranges somewhere in this vicinity, if it's more than 10%, 15 or 20 or whatever, I mean, how does that impact you, or is it all completely built into the deal with your US client? I mean, does it impact the offtake in any way?
So Surbi, I think so more than Japan, I think so we should look at manufacturing nations which are manufacturing mobiles, which is majorly China and Vietnam for us. So China, we feel confident that there will always be a decent arbitrage and like the way it is today, and hopefully it should remain that even if the deal is not closed with India today. And the other is Vietnam. Vietnam deal is already announced. So let's hope that our numbers with Vietnam should be lower. Yeah, so that's we are hoping for.
Okay. Just one last question, Saurabh. Rare earth, any impact? Restriction on rare earth?
Not specifically in mobiles or per se, but yes, it has some kind of impact in our variables business, but there are alternatives being worked out. So not a big impact for us as of now.
Okay. All right. Saurabh, good discussion. I think we covered a lot of ground and thanks very much for all the details. Appreciate it. Good luck. That's Saurabh with Dixon Technologies with some perspective. Markets, by the way, are down about 35 points. Just look at Idea Forge, another name which is seeing a bit of a crack now. So Idea Forge is down about 6% at this point in time. Tejas Network is down about 3%. Actually, in the mid-cap side, there's a lot of stuff which is moving. I mentioned Ion Exchange. Volumes are large on this one. We'll check if there was earnings or something else. Oberoi Realty is down about 3.5%. India Cements is down about 3% or so. Raymond is down about 2.5%. Jana Small Finance Bank is another one. I think it's down 6% at this point in time. Kajaria is down about 3%. And these are all large liquid names which are seeing some activity as things stand right now. On the way up, if I can spot any outliers, Nigel mentioned Bombay Dyeing, which is up 9%. Anthem is up, the recent listing, 30% pop on day one. It's up another 3.5%. It's got very large volumes on it. Credit Access, of course, we mentioned. Sapphire Foods is up 5% at this point. There's a stock called Infobean. It's just coming up with very large volumes. 533, stocks up 19%. Not Infibeam, Infibeen ends with an N.
No, I didn't know that existed. I thought you were talking about Infibeam, Prashant.
I don't think we have it, but it's showing up. But I think it's the 6th or 7th largest volume traded name on the NSE. So yeah, things are popping all over the place. Leela, we just had the management with us, about 2.25% higher. Godrej Agro is up about 3%. So yeah, there is a lot of action, a lot of
Sapphire is running very, very hard.
Sapphire is up.
Sapphire is up 5%. You have Anthem Bio as well. It's given you a big listing pop and it's building onto those gains as well. So massive move out there. And we were talking about the refiners a couple of days ago. MRPL, the numbers look very, very disappointing. But it seems, the street liked what they had to say in their con call. And that's why, actually the stock is now above what it was prior to the earnings. So it's recovered all of those losses. And CPCL is the one that we'll watch out for in terms of their numbers in the coming days. So we'll keep an eye out on that name. For the time being, it's down 1.5%.
Nigel, Hormuz has spotted that stock for us. We'll get it added. It's Infobeans, right? Ends with an N again. 2.5 lakh shares traded, and that's why I spotted it. 20-day average is 600 shares, and that's why it came up on my screen. That's the one I'm talking about. 600 average and 2.5 lakh shares today. It's a software development company, Hormuz tells me. So we'll have more on this one in Hormuz's unusual mover segment a little later in the day. But it's a pretty vibrant screen with enough up and down as well. Market breadth, though, is slightly negative. We take a quick break here. Mitesh Thakkar joins us on the other side.
There are close to 2 crore shares that are traded in 1 hour of trade. Anything you're looking at on the charts? I highlighted a few days ago that there was massive delivery-based buying on this name.
Nigel, you're right. I think this is one stock which has given a breakout on short-term as well as medium-term charts. The minimum target I'm looking at is about 190, 195 zones. But logically, I think the stock could even head towards 220 plus. So extremely positive over here on the medium-term chart basis. Slowly accumulated because the stock has already moved up today. But yeah, I think, traders should look to get into this. And as long as the stock is above 165, 164, good chance that we'll eventually see 220 over the next few weeks, maybe a couple of months.
Okay, got it. Quick word then on the markets as well, the Nifty price action, and give us your couple of stocks as well.
Nifty, nothing much. We've had a opening and then we've been kind of very flat. And I've said this that, we are most likely doing a range of about 25,300 to about 24,900. So we're still in the middle of the range. But Bajaj Finance is something, which comes on my list. It was a buy a few days back as well. Good setup over here in terms of hourly and 2 hourly charts. So keep a stop at 950, look for targets of 990 plus. And a lot of real estate names have broken down. Today we are seeing some negative movement in Lodha, DLF, as well as Prestige Estate. So Lodha Developers, which is Macrotech, despite the fact it's down 5%, slowly shorts can be taken with a stop about 1380 and a target of 1300 is what I'm looking at.
Okay, all right, great. Thanks a lot for that, Mitesh. Well, let's focus on SBI then. They raised 25,000 crores by India's largest QIP. Our colleague Yash Jain caught up with the SBI chairman, Mr. Sethi, and asked him about how will these funds be deployed. Let's listen in to what he had to say.
We always had adequate CRAR, the capital ratio, which helped us to achieve the credit growth. Maybe, we were saying 6 to 7 lakh crore credit growth could have been supported without raising this capital. But this augments our common equity tier 1 capital. So the CET1, as you know, will improve up to 11.5%. Our end objective is to take the CET1 to 12%. And also the CRAR increases to 14.9%. And probably we will have 15% CRAR through the cycles. Correct. Which means that these two capital ratios, while not very significant from the credit growth point of view, but will definitely provide the confidence to the system, investors, regulators. This is the purpose of that.
The second question, sir, the major investors which come through this?
I think there's very diversified investors. Obviously, there has been a good demand from the overseas investor, and that shows the confidence in the Indian economy and SBI in particular. Very diversified customer base, and of course, there's been a good demand from the local AMCs, DIIs, what we call. I think it has been a very diversified one.
Okay, second question, sir. As far as the 25,000 crore is concerned, now the need to value unlock some of your subsidiaries, SBI Mutual Fund, SBI General, does that go out of the window at least for the next 1 year? And what happens to the deal with Yes Bank?
So we did mention earlier that our various components which we have, it could be S Bank or NSE or subsidiaries, all these are still on the table. Nothing is off the table. Our end objective is to further strengthen the CET1 capital, and we will use all the components at the appropriate time.
Okay, all right. Well, let's focus then on some stocks on the move. Dalmia Bharat, well, that's reacting to its Q1 performance. And, at the start of today, we said that the numbers were good. But now that surprise element actually is missing. And the stock in the last 1 month or so, today it's come in for profit taking. Pull up a 1 month chart. The stock actually has seen a big rise of more than 10%, even after this 2% pullback. And it was closer to around a 52-week high. The numbers look fairly okay. Top line was a small miss. The EBITDA number actually was better. What played out here? If you pull up the EBITDA per ton, it came in at around 1,261 rupees, which is a sharp improvement both on a sequential basis as well as on a year-on-year basis. The problem was on volumes. They have degrown by close to 5%. That's, even if you exclude the JP volumes, which was at around 0.4 million tons, then as well, the number is more or less flattish. So no volume growth is something that the street will be disappointed on, because that means they're losing market share. Though on the realization parameter, there was a positive surprise. Since they have a fair bit of exposure to South India, realizations went up by close to around 9%. Their longer-term time horizon is good. Currently they're at around 50 million tons. They laid out a plan to get to the mid-60 million tons or thereabouts with the plan that they've raised. They've already announced a capex as well at roughly around $65 on a per-ton basis. And the capex spend that they've earmarked is close to around 3,000 crores for a 6 million ton capacity with a 3.5 million ton clinker capacity as well. So the trajectory is good. They're going to be becoming a larger size cement player by 2028, when they're saying they're going to be a 75 million ton unit. However, lack of volume growth seems to be plaguing the street, and lack of a positive surprise as well, is the reason the stock has come in for profit taking, because the street sniffed it, had already run up in anticipation to these numbers. That's about Dalmia Bharat. I'll tell you what, we'll slip into a short break, but Manisha is waiting for us on the other side. She'll tell us all that's going on in the commodity space.
Welcome back. Well, let's shift the focus now to the commodity markets. As promised, we have Manisha joining in with the latest. Manisha, good morning. So what are you tracking today?
Oh, it's a silver lining to silver, really, because we've seen very strong gains come in for this one. Silver actually is outperforming gold when you look at the last 1 month or YTD numbers as well. There you have it on your screens. So in last 1 month, we've seen gold prices gain up by 3%. Silver is up by 9%. In this year now, silver clearly is taken over on gold. With 32% of gold gains, we've seen silver gain up by 36% there. So when you look at the gold prices, we did see an all-time high in this year, in the first quarter itself. And even at this point in time, gold is trading at around 5-week highs into the markets. When you look at the gold prices, we're just about $60 away from that all-time high of around $3,500 an ounce. We seem to have slipped slightly more from those kind of levels. But when it comes to silver, well, we are trading at a 14-year highs in the international markets, and for the Indian markets, it's an all-time high at around 1,16,000 rupees a kg there. Well, a lot of supportive factors onto this one. To begin with, China has been pledging, talking about a lot of push when it comes to infrastructure projects coming in from the government itself, whether it is in space of auto or electric equipments, and that's exactly where silver usage will go higher. The global silver industrial demand in 2025 is expected to be at record highs. This would be a 4th straight year of industrial demand hitting record numbers in the global markets there. Also, the global gold and silver ratio trading at around 84 or 87 thereabouts is quite supportive for silver buying further from here in as well. The strong silver fundamentals are in case of supply and demand numbers as well. 2025 is the fifth straight year of deficit in the global markets there. The street is also looking at demand and supply numbers for this year, which are on the positive side. So when you look at the demand, it's expected at 1.20 billion ounces, while supply is at 1.05. And there's no carry forward from last year because this is the fifth straight year of deficit, and that clearly is giving support to silver prices there. Also, when you look at the ranges that the silver has put in, you can see it's on the higher highs. In 2023, $19 to $27 an ounce of a silver range is what we saw. It gained up to 22 to 35 in the previous year. And in this year until now, we've seen a higher range of around 29.5 to 39.5 or thereabouts for this year, with Street anticipating that you could be looking at higher highs going forward. And that's exactly what most of the banks and brokerages seem to be putting out. From JP Morgan to Bank of America to UBS, $39 to $40 an ounce is an expectation of an average silver price for 2025. And that just continues because when you look at the other banks like Citi, Stancy and Saxo Bank, they're also talking about 40. We're not too far away from there, but 40 of an average is what they're talking about. So if we've done 29 and 39 is where we're trading at right now, markets do believe that you could be looking at 42, 45 on the higher side before this year ends.
Okay, so silver continuing to sparkle and shine. Thanks for that, Manisha. Well, with that, we're coming back to the equity market. The mid-cap correction is now well entrenched. The mid-cap index is down about 0.5%. The Nifty is holding on to gains of about 35 odd points now. So we've cooled off from the opening highs. Onto some stocks. Vinny is tracking Aurionpro this morning. Stocks under a bit of pressure. Vinny, what's happening?
Hi, good morning. So this is coming in after their earnings that were reported late last night. Now, when you're looking at it, the Q1 FY26 number on a quarter-on-quarter basis, revenue has just seen a growth of 3%. Profits are up marginally by 2%, while margins have remained almost flattish at 20.3% this time versus 20.2% in the last quarter. This is the EBITDA margin I'm talking about. They've added 16 new clients. But what is the factor that comes into play? Sequentially, when you're looking at this 3% growth rate, that is one of the lowest growth rates that the company has seen, or the slowest growth that the company has seen in almost 2 years. And on a year-on-year basis also, the growth is just coming in at around 28.7% for Q1 FY26 versus Q1 FY25. So that growth is also significantly lower. And the last time we'd seen such slow growth rate for the company was somewhere in September 2022 on a year-on-year basis. Now, when last we spoke to the management as well, they'd given a growth guidance of 30% CAGR growth for FY26, full year growth. Now, clearly, 28.7% is slightly below that. So that is a bit of a concern. But in the press release, the management has highlighted that, they are on course to meet that full year growth guidance. But we'll have to wait out for more factors coming in from them in terms of banking. How is that doing for the company, as well as the tech segments? These are important for the company. As of now, a weak number coming in at least on the top line front. PAT margins are in line with their guidance that they're given.
Okay, all right, Vinny, got it. Thank you very much for the details over there. With that, we do have to take a very quick break. Coming back on the other side, Lata will be in conversation with Shantanu Chakrabarti of BNP Paribas on the Q1 banking results we've seen so far.
Largely been above market estimates. ICICI at one end has, of course, been exceptional, while Axis Bank disappointed with higher slippages, albeit technical, they called it. But are the numbers all priced in, and how will the rest of the year pan out? Joining me, Shantanu Chakrabarti, India analyst, BFSI at BNP Paribas. Good morning, Shantanu. Thank you very much indeed for joining us. Well, your best pick is HDFC Bank. I would have thought, going by the results, ICICI Bank with margins, which is about 70 basis points higher than HDFC Bank's, would steal the cake. But anyway, let's go one by one. HDFC Bank, what makes you so confident that the mean will revert and they will come back to that near 4% margins?
Right. Good morning, Lata. First of all, it's a pleasure to be here. And you're right. I mean, if I have to name a leader in the entire banking pack today, I think the baton has arguably changed hands from HDFC to ICICI a while back. Some of it may not be within HDFC's control. After all, when you get a full, large wholesale liability franchise merged into you, your liability strengths on a percentage basis do not remain what they were. My argument in HDFC Bank rests on the simple premise that there are certain new realities with the new balance sheet, which is basically that fundamentally this is now going to be a lower margin business. But at the same time, thanks to the scale that comes in, it is also going to be a lower operating cost business. And finally, within the next 2 years, you will see exit ROAs and ROEs converge with its pre-merger levels of 2% and 17% respectively, which should drive the full re-rating. In fact, the anticipation of the same or visibility of the same should be enough to drive the re-rating back to something, if not the older multiples, something fairly north of where things stand today.
Okay.
Having said
that's
that,
very important. Yeah, sorry, go ahead. Sorry.
I said that having said that, I have, no reservation in calling out that as of today on landed cost of liabilities, even adjusted for scale and operating cost, etc., ICICI has a clear edge over everybody else. It has the greatest privilege in banking, which is the ability to pick and choose the risks that you want because you have a cost edge. As far as HDFC Bank's results go, frankly, Lata, I think post the results, markets have probably treated the bank stock a little better than I would have expected it to. Because on margins, just you were pointing out, ICICI's margin performance. Quarter on quarter, the dip for HDFC Bank was a little sharper than most people expected, right? I mean, it's not a deal breaker in terms of a long-term thesis, but the immediate reaction being positive despite that is something which is quite interesting.
Okay. No, I agree with you. I think everyone is believing what you are saying, that even if the margins don't come back to the 4% plus, they will manage on ROE because of other reasons. But even the ROE is about 14.5, isn't it?
Right.
Compared to, I think, ICICI 16 plus, almost 17. So by when do you think HDFC Bank gets to its old ROE? Is that happening end FY26 exit of this year? Is it happening exit FY27?
Right. So, Lata, to answer that question, the first thing we have to keep in mind is the amount of legacy liabilities which are high cost, which they have inherited from their erstwhile parent. This comes in two primary sources. One is the non-convertible debentures, which HDFC had issued. On that, the expiry schedule is available with us. And therefore, we know we have about 1,90,000 crore kind of numbers still outstanding at about 8%. And similarly, there's, of course, term deposits, which have been grandfathered in from the erstwhile parent, which would also be typically at 50 basis point, 25 to 50 basis point higher costs than what HDFC's equivalent cohort would be. So both of these, I think the expiry schedule on both of these ensures that on a secular basis over the next 7-8 quarters, each quarter HDFC Bank has an incremental tailwind of 2-3 basis points building up sequentially every quarter on margins. Now, that may not sound like much on a per quarter basis, but if you add up, it adds up to almost 15 to 20 basis point of margin tailwind over a 2-year period. Now, other than that, there are, of course, cyclical factors at play. Please understand that if I calculate CASA as a percentage of total liabilities instead of deposits, HDFC Bank's CASA today is below 30%, right? So, and of course, there's a CASA engine out there, which even though in the last year has been outshone by ICICI Bank, in the 3 previous years before that has done a fantastic job of shoring up whatever little was available in the system. So from that point of view, as the easing continues and low-cost funds become more and more available, HDFC Bank should be in a good position to take advantage of that. And I think in management commentary also, you can see allusions to that factor. When management is saying that, that we are basically now willing to accelerate in the first stage, bringing it to 95% credit deposit ratio and mobilizing money was the key, while now we become more selective, more aggressive, better cross-sell to clients and so on and so forth. Now, obviously, they have the machinery to get that done. So I think, they remain a very counterintuitive beneficiary of easing, even though they are 70% floating rate assets.
Okay. Yeah, we are forgetting that even if you look on a year-on-year basis, that stock has given about 15% returns. It was around 1,700 same time last year. So it's a fairly decent return in terms of stock price as well. Obviously, most people believing what you are seeing, that the ROE will come in good time. Now, I have a more general question before I delve into the specific of Axis and ICICI. Do you think that the banking system or banking investors are not prepared for a much lower credit growth? The credit growth numbers, fortnightly numbers, are still single digit. Now, is it likely to remain that way for the rest of the year, given that credit offtake is... I mean, most bankers are telling you credit offtake is not happening.
So, Latha, I mean, the way I look at this is that whether any future rate cuts pan out or not, simply from the amount of liquidity available and the soft indicators that RBI is putting out, the subtle change in tone that you see in commentary of the banks, where they are saying, we are well poised for growth, etc. I think we are at the cusp of a small growth acceleration, but let's keep that in context. I'm not saying that we are going to go back to 17-18% credit growth. I think we exit this financial year with about 13% credit growth, which is still almost 300-350 basis point acceleration over where things stand today. Now, what gives me that hope? This quarter was the last quarter where a high disbursement number was in the base for retail loans. The next 3 quarters of the financial year actually have low disbursement numbers for retail loans, mainly because of the pullback that happened within unsecured loans and credit cards in this corresponding period last year. So I think for the full year, the banking system should be able to deliver 14 to 15% credit growth in retail. Just from normalization, not from going back to the gung-ho days of 25 to 30% growth in, personal loans. I'm just talking of a normalization. We, of course, remain constructive on the SME sector, and their 17 to 19% kind of growth seems to be holding on very well. The only laggard is going to be the corporate sector, in our opinion. I'm sure, the 101 arguments can be made as to why, it's just right at the cusp of an acceleration, etc. But I think given where the global macros are, if you talk to most promoters in India, very few people have the appetite to be jumping into large projects with long-term bank financing right now, especially when, a lot of foreign financing in the debt markets is available to them, right? So I think 6-7% corporate loans is what you should be budgeting for the year. But that still gives you a very solid 13%.
Okay.
And since
I agree with your 13% exit, maybe not 30, at least 12, but the average for the year could still be single digit is what everyone, I mean, every banker after banker tells me, we have money, but whom do we lend it to? That seems to be their problem. But anyway, we are running out of time. Axis, is this the last of the accidents? I mean, this came out of nowhere. Would you still, you're still betting the house on Axis. Where does this confidence come from? Even the loan growth has been muted.
Right. So, Axis has disappointed continuously for the last 4-5 quarters by small measures, which is why the hope has not died, but it has been frustrated again and again and again. So firstly, let me highlight what are the 2 things working in its favor. One is, of course, the valuations. If anything's trading at 1.6 times 1 year forward, and it's a 40% CASA bank, which still can do mid-teens ROE, without huffing and puffing too much in terms of what risks it takes. It looks like good risk reward. Second is on the liability side, given the degree of short-term funding that they have available, they remain one of the early responders on cost of funds as far as an easing cycle is concerned. That's what's working in its favor. What's not working in its favor is ever since the merger and having digested the merger, in the last, especially in the second half of the last financial year and this year, headline growth numbers, whether they be on deposits, on loans, on low-cost deposits, that is CASA, it's been a bit of a disappointment. And there's just no squaring that circle. Even on credit costs, I will take you back to first quarter of the last financial year when the first spike happened. And they had, they didn't call it technical, but they said specific assets, we had to do some recognition. And, large part of it, they implied that it's going to get clawed back. But adjusted for what happened with NARCL in the last quarter, where they got a release purely because of change in regulation.
Yeah.
Otherwise, the true credit costs have averaged at about 83 to 85 basis points, right? Which is significantly higher than where the other large banks are posting. And they are talking of a retail asset cycle in a period where others see it normalizing, the minor cycle we have had in the last year. So, yeah, it's been frustrating, but I still think it is one of the better options for beta. Is it as at high in our pecking order as HDFC and ICICI? No. But it is one of the smarter beta plays, especially in a situation where, IndusInd Bank in itself is a harder buy for most people, given, the uncertainties around the name.
Okay. Yeah, if one is perhaps looking at a beta, then maybe Axis has a better chance. But still, you are looking at an almost 40-45% jump from the current 1,100 rupees to, 1,600 plus, which is your target. Right. That looked ambitious to me. Actually, I have more questions for you in terms of the MSME loans, but out of time on another day. Shantanu, thank you very much for joining me to analyse the results of the big banks that have reported so far. There are many more to come, especially the big SBI. We'll analyse that as and when. For the moment, a short break and then Chartbust.